Hey, good morning, afternoon, evening, wherever you might be. We have customers all over the globe. And it's great to have all of you joining us for this event this morning. This is John Hopkins, going to be joined by Tom Boley and Aaron Weber in just a few minutes. Said this before, but I'm in sunny Charleston, South Carolina. Crisp, even for this time of year, but I guess a nice and sunny and great way to start the day. I want to take the opportunity to welcome anybody new to Earnings Beats. I know a lot of you have followed Tom for a while, seen some of his writings. Appreciate you taking the time to stop and learn more about what we're doing. Of course, welcome all of our other members, seasoned members. You know, Tom and I started the company back in 2004. And it's been through a few iterations since then, evolving into Earnings Beats. And believe it or not, we've got some members who've been with us since we started back in 2004, which is quite satisfying. We really, really appreciate it. I want to let everybody know this event will be recorded. We record all of our events, and make sure you get a copy, hopefully sometime later today. Aaron will get that out to you. And, you know, we archive all of our events. We've got a lot of great material from, the past year, maybe even longer, that covers a lot of great information. And we'll be adding this one to the archive as well. This is really all about a life at earningsbeats.com, what we're all about, some of the tools are, and some exciting things that have just changed. A lot of new features, coming into play. I watched with amazement this past week or so with GameStop and everything that swirled around that stock and some others, and had to really stop and reflect upon one of the new features that we added a couple of months ago that Tom, I'm sure, will talk about, the short squeeze chart list. Number one on that list was GameStop. Then there's BlackBerry. Then there's this one and that one. Really kind of ahead of the curve. And amazed to watch. I don't know about you, but I've never seen anything quite like what's going on now. People I know with kids, different generations, everybody all of a sudden has become interested in the market. And so it's going to be a fascinating time as we, move further into 2021. We're just very excited and appreciative, really appreciative of your support, which allows us, to continue to grow and build. And last thing I want to say, in addition to Tom, I'm so happy that Aaron Weber is going to join us today. Aaron's been very instrumental in helping grow this company. And I'm so glad that she's on board. Got 2 CPAs that are part of this company now. And of course, Abby, customer service, done a bang up job. And Matt Townsend has been doing a lot of work with Tom to give you some of the new features. And of course, Chris Hopkins, who's in the background, but also very important. So anyways, we appreciate the team. Really appreciate you all being with us today. I'm going to see if Tom's ready to roll.
I'm ready to go.
Yeah, it's great to have you and Aaron today. I'm going to step aside, and I want to mention to people that Aaron's going to be talking about frequently asked questions as well as some Q&A. So we'll get to some of that a little bit later, Tom, as we move into that section.
Yeah, we got a lot on the docket today, and this is going to be a fairly lengthy webinar, but it is being recorded. At the end of it, I'm sure, Aaron and Abby will work on things and get things time stamped. so that you'll know exactly, if you want to come back in and you want to, you missed a part or something, it should be, somewhat fairly detailed in terms of, where you can scrub to kind of pick up where you left off. I know it's a Saturday, you may have some other things to do, but it's also a great time with the market closed for us to go back. I mean, like John said, we added short squeeze chart list, but we've added so many features over the past 12 months that we're really at a point where I think we need to kind of catch our breath a little bit and go through a lot of these features. And they'll get better over time. But right now we're just trying to add them into our website, into our arsenal, our, what I like to call research and educational platform here at Earnings Beats. And so we want to just stop and go through some of this because we are getting questions. I know we provide a lot of information, and I know for a new member coming in, maybe you've been part of a service where you just get trade alerts, or, somebody just says, here, buy this, sell that. That is not what we're about. There's definitely a lot for traders, a lot of opportunities. I think there's a lot for those who buy and hold. I think there are different opportunities there. We have opportunities for ETF traders and investors as opposed to just stock. There's a slew of information on our website, and I just think it's a good time to take a step back, take a deep breath, and kind of walk through everything with both our existing members and then some of you who may be new to Earnings Beats today. And maybe you read my articles and you're just curious about what we do. I think this will be a really great session for you as well. So we look for it really to be a refresher for members who have been with us for a little while, or maybe some of our new members, a little bit of a how-to. And then for those of you who are new to Earnings Beats altogether, maybe an introduction to some of the things we do. But let's go ahead and bring up the agenda because we got a number of things that we want to get through. Of course, the introduction. Welcome, everybody. There you go. That step one's done. I'll do a really quick website walkthrough. And one of the things that we have as a project in 2021, hopefully we can get it done by the end of the year, is we really want to redo our website. This is a little bit of an older website. I think those of you who have been members for a while have gotten used to it and so forth, but there's so much more that we could do in terms of a website. So that's a project, just to let you know, that we have at least on the back burner right now that we'd like to address in 2021. Make it a little bit more state of the art and more intuitive, but we'll get to all that somewhere later. For now, I want to give you a walkthrough with where you can find things and some of the services that we offer. I'll go through our free EB Digest newsletter. It's an extremely popular newsletter. It's free. There's no credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. Really, the Digest, this newsletter, is really a way for us to give back to the community, teach everyone a little bit about how we view the market. If we happen to be a match and you like what we do, that could be kind of a launching pad for you to come on board as a member at Earnings Beats. So that's the whole idea, is to help educate and at the same time show you a little bit about what we do. Then I'll go through our stock research and education platform. And that's where we get most of our questions. Our ETF research and education platform is fairly new. It's just started here. We kind of introduced it in the fourth quarter of 2020. Just began really rolling things out here in 2021, and we're still in the process of rolling some things out. But I figured between the two would be a good time maybe to take a break and go over some frequently asked questions. So Erin Weber will be joining me for that. Of course, she sees a ton of the questions that come in. So we want to try and hit some of those bigger questions and maybe cut down on some of the questions that go into customer support. Maybe you'll have a little bit better idea of some of the more frequently asked questions that we have or that we receive. Then, like I said, we'll jump back into the ETF research and education platform, and then there'll be a Q&A. So if you have questions about our website, you have questions about our chart lists, our portfolios, anything like that, try to go through and answer those questions for you. And then we'll wrap up with a little bonus, the January effect. Sometimes this is a separate webinar, It won't take a long time. It's one spreadsheet. I just want to show you the impact. I think you'll find it fairly fascinating if you're not aware of it, but the impact that performance on the S&P 500 during the month of January, the impact that has on the balance of the year. You know, you might think, well, if you have a big January, you're probably done for the year. It's quite the opposite. And you think if it's a bad January, you're going to rebound because we've had a bad month. Again, quite the opposite. But I'll show you history going back to 1950 on what we might be able to expect in the balance of 2021 based on just the January effect. All right, so with that, let's go ahead and get started. I want to give you a quick walkthrough of just the website when you log in. So bear with me. Let me get this up on my screen. All right, you should have it. So I've just logged in and I'm on a home page. And so this is what you see. Like today, we have a member announcement. If we have anything special, any kind of member announcements like this, you'll see it on this page. And this would be, especially if it's something like a members only webinar, you definitely would see it on this page. You would not see it on the public homepage. So in other words, if you just come to the website and you haven't logged in, you'll see this today as well because it's open for the public. But if we have a members only webinar, this would be one page where you'd be able to come in right before the event starts and click on the link to join the session. All right, so really just kind of a basic homepage here, but down the left side is really where our research and education lies. So I'm going to go down and just walk you through everything here. If you want to read a little bit more about John and me, not sure you want to, but if you do, you can find it here. We do have frequently asked questions already on the site, but as I mentioned, we've been updating our services pretty rapidly here over the past several months. And so this will give you some good information, but it'll be changing. We'll be constantly updating this, and it'll probably undergo a little makeover here pretty soon. So just keep that in mind. But some of the basic questions you should still be able to find here. Our service, again, because things have changed so much, doesn't cover everything, but it covers a lot of what we do. And again, I'll be going through everything. Event calendar. So if you come in here, you'll be able to see things that we've already scheduled. Now, we'll be adding some more webinars for February, but currently we do have of course, this webinar today. Our regular monthly max pain, if you interested in seeing how stocks tend to perform heading into options expiration, we've got recorded max pain webinars in the past, and I'll show you where you can get those in just a bit. But this is a really great event. And then, of course, every quarter we have our top 10 stocks for each of our portfolios. I call it the draft. And that comes up on February. Normally, we do it on the 19th of February, May, August, and November for our stocks. This one is on the 21st because the 19th is on a Friday. And I don't know about everybody else, but I don't really want to do a webinar on a Friday night. So we'll do it on that Sunday evening, right before the market opens on Monday. Mark your calendar. That'll be a really big event. By the way, if you're not a member at Earnings Beats, your 30-day trial, which essentially is a no-cost trial, would cover that event. Next 30 days essentially gets you the month of February. So you would be eligible to join us for that. Daily market report sample. This is an older one. We'll probably update it soon, but just give you an idea of what we offer, and one of the things that we offer, the daily market report. Trading Places blog. If you're not familiar, I do write a blog fairly frequently. I would say once or twice a week. I used to do it daily or every day the market was open when I was senior technical analyst over at Stock Charts about 1.5 years ago. But since coming back to Earnings Beats as its chief market strategist, I now post there, but much less frequently. Probably, like I said, 1 to 2 times a week is kind of the norm, maybe 3 times on a busy week. Going back, so that's the Trading Places blog. Here's a link to Trading Places Live. I do want to point out that if you miss a live event, I do these at 9 o'clock in the morning, Mondays and Wednesdays, right here at Earnings Beats. If you come in and click on the About Us, even if you're not a member, if you click on the About Us, there will be there'll be something that comes up over here on, I think maybe right under Trading Places Live. there'll be a big, huge button that you can click to join in to that show. So that's every Monday and Wednesday at 9 to 9:30. And of course, I do Trading Places live over at Stock Charts on Tuesdays and Thursdays at the same time, 9 o'clock Eastern. So if you miss an event though, or you miss one of these shows, just go to our YouTube channel. If you click on our YouTube channel, it'll have a lot of the recent shows already right here on the channel. What I would like you to do though is subscribe. We'd love to have you subscribe to our YouTube channel. So make sure you do that while you're there. All right, getting into our stock service. And I'm going to come back, circle back in a bit and go through all of these, but I just want to kind of give you a quick update on the things that we do or that we've been doing and some of the things that we've added. So one of the things I do every day is I send out a daily market report. So here is the market report from Friday. You can scroll down. You can always get this at the website. Occasionally, I'll send out an email, and our mail server, if it's down or if it's just slow, sometimes it just spits out emails periodically throughout the day, and some people don't get their daily market report until after the market closes. I want you to be aware that you can come to the website, and usually it would be a rare instance that I post on here be past 3:30 in the afternoon. Market closes at 4 Eastern. So normally by 3:30, if you haven't received an email from us for the daily market report, come into the website, click on the EB daily market report under stocks, and it should be here, because when I mail it out, I post it to the website at the exact same time. The posting to the website is immediate. Emails normally are very quick. But again, if there's some kind of a backlog and they just go out slower, it's possible you don't get it. So if you're thinking, oh, it's 3:30, I haven't received it, come into the website. You should be able to find it here. EB Weekly Portfolio Report. Every Sunday morning, I do a special report on our portfolios and send this out. I'll come back and look at that later. Monthly Seasonality Report. We just started this the last couple of months. If you're interested in knowing which stocks have a tendency to go up during different periods of the year, different calendar months, this is a report you're going to enjoy. So I start off, well, I'll come back again, circle back, but I want you just to know it's here. It's a seasonality report that just focuses on stocks that have a tendency to perform well during a certain time of the year. EB Monthly Short Report. This one was just started. Talk about timing. We just issued our first one for December 2020. I believe it was issued on Sunday, January 3rd. So this went out almost a month ago. And if you look at some of the stocks on this list, and again, I'll come back to it in a bit, but it was probably the most profitable letter, anything that we've done at Earnings Beats over the past 16 years, 17 years since we started the business. I mean, the stocks right here, these 10 stocks were going crazy in the month of January. Maybe not all of them, but some of them. And I'll go through those in just a bit. Chart lists. First of all, a lot of what we do at Earnings Beats, I would highly recommend that you take out an extra membership or above at Stock Charts. We get nothing. If you sign up there and you pay Stock Charts, we're not getting anything. We get no referral fee. I'm not asking you to do it because we're going to get some kind of kickback. I'm asking you to do it because it absolutely marries perfectly into our service. I use it. I use Stock Charts. I think you'll get a lot more out of our service, and you'll learn a lot more about Stock Chart service if you're members of both. We both have 30-day free trials. So if you haven't tried it, this would be a great opportunity to do so. I'll come back to the chart list, but chart lists are a great way to organize your work. And all the research that we do gets organized into chart lists. And if you're an extra member or a pro member at Stock Charts, you can download our information, our work, our research in seconds right into your Stock Charts account. Scanning strategies. If you're not familiar with how to scan over at Stock Charts, we have some syntax that we've created, just some very basic. We have 5 different strategies. I'll go over those, but we also provide those for you. Portfolios. On our website, if you come in our public homepage, you probably see this quite a bit. Our portfolio performance, we update it every day on our website, usually. So we keep it up to date. We have the performance of each of our portfolios since they were started, and we give you the inception date. We also give you updated performance on the current quarter, and then we give you the benchmark since inception, not since the inception of the benchmark, but since the inception of our portfolio. So for instance, the model portfolio, if you look at that, since inception, in just a little over 2 years, we're up 211.79%. The S&P over that same period's up 38% since the inception of our model portfolio. And then this quarter also ties in. Now, keep in mind, this quarter is not January 1st to March 31st. This quarter is when we started our latest portfolio. In other words, when we announced our portfolio picks, which was back on November 19th. So our current quarter will end on February 19th. So we got about 3 weeks left. But that's the quarter so far, model portfolio versus the S&P 500. You can see we've done pretty well in these portfolios, and all of this ties together. I mean, and hopefully as we go through all these different processes, you'll understand. Webinars. John mentioned we have a ton of webinars. Well, here is the list. This is just since May 19th of 2019. Here are the recordings. So you can see we do a lot of them. If you wanted to go back, for instance, and see the strategy and what we do when we go through and do our top 10 picks for our portfolios, not only do we have the top 10 picks, you can see here, the quarter 4 stock picks right there. But we also do, usually a week before that, we'll do a sneak preview and kind of explain our strategy and so forth. So once you've seen one of these sneak previews, you've seen most, although I do have some specific information as far as which areas of the market are performing well to kind of give you an idea of what I'm going to be looking at in terms of picking those 10 stocks for each portfolio. And then a week later, we actually pick the portfolio. And we do it in real time, and we do it as of that day. We provide it to our members, not like, we go back 4 weeks later and say, well, we talked about this one. No, we give you the 10 stocks that go into each of the portfolios at that moment, and then we track performance every day. But you can go through and look. I mentioned the max pain. There's the max pain for November. Here was the max pain for January and December. You can go back, max pain for October. There's max pain August, and so forth. So you go right down the list. You can go back and take a look at any of these recordings. Today's recording will be in here. So what we're going through right here will be in here. And we'll make sure that this is sent out because it is a free webinar. We'll make sure it gets out to our free crowd as well through the EB Digest. Also, before I forget, any of you who are coming in directly into the room and are not already part of our community, we will add you to our EB Digest newsletter. No credit card required. There's no cost. You can unsubscribe at any time. So if Monday morning comes and goes and you're not interested in what we provide, unsubscribe. Again, you're not going to hurt my feelings. For whatever reason, maybe our styles don't mix. Maybe you don't like the way I look at the market, whatever, it's fine. But we do have a huge growing list, and love to have you as part of it going forward. All right, so that is, well, I got one more. So exclusive content under stock. So for our annual members, sometimes we do a lot of research, proprietary research, and I just feel a little uncomfortable just handing that out to somebody who comes in on a free trial and then leaves and takes it with them. So I do ask for a couple of things that we do that you commit to us. I feel like it's commitment on our part, and so we like to have commitment on the other side as well. So we have our sector relative strength chart list and our industry group relative strength chart list, which really is almost at the heart of what we do in terms of a top-down approach to the market. And the relative strength is so critical. I can't tell you how many emails I've gotten from members who have said that relative strength and the way that we view relative strength and present it has made such a huge difference in the way in their performance and the way they look at the market. They wish they knew about it 30 years ago, that sort of thing. Well, it all starts with these two chart lists. And then also occasionally, as John mentioned at the beginning, Aaron and I are both CPAs, so we never met spreadsheets we didn't like. And so every once in a while, we'll come up with spreadsheets, like a spreadsheet showing the 104 industry groups and how they have reacted since the vaccine news came out on November 9th, the first positive vaccine news. That's when Pfizer announced. So we looked at what had been happening up until that date, and then we look at what's happening after that date, and it provides us a lot of great information, but it's proprietary. It takes a long time to put it together. And so if you want that information and if you want to download that spreadsheet, great, but we do reserve that for our annual members. ETFs. All right, so this is a fairly new part of our service. So we just started offering, we had a lot more folks that asked about ETFs. They didn't really want to do stocks. And ETFs is not something that I really get into. And the main reason is I can't pick the stocks. So we've taken it a step further with the ETF portfolio, and I'll show you some of the things that we do later on. We do have a monthly portfolio report that's kind of under construction. I'm hoping that we'll do our first one this weekend, maybe sometime during the week. I've had a lot going on. I don't know if I can get to it, but the thought process was that it would be out this weekend. We'll see, but that will be coming soon. ETF chart lists. Just like the stocks, we have chart lists for our ETFs. I'll go through those in just a bit. ETF portfolios, we have a model ETF portfolio where you can come in and check out the results. And then ETF webinars. Again, we just started with this ETF service, but if you're interested in how to build an ETF portfolio the right way, in my opinion, the right way, you can come back in and listen to this recording. Also, the actual model ETF portfolio that we announced on January 19th. The recording is there as well. So these were just a couple of recent webinars, but we'll be adding to our library here. We have another EB ETF analyzer. This is another spreadsheet that's proprietary in how we put together our ETFs, and I'll show you this a little bit later in the event. But that is proprietary, and we do want you to be a part of us longer term to be able to download that. All right, let's see. How about, I'm going to leave some of these other resources for questions that may come up in our frequently asked questions later. Instead, I'm just going to move right into our next segment, which is the EB Digest. This is our free newsletter. If you see down here under resources, and we may move this to some other spot here on the left navigational panel, but for now it's just under resources. But if you click on that, you will see the latest Earnings Beats Digest newsletter. Should pop up here in just a second. We'll try it again. There we go. So we do have the articles here. And you can scroll down. We've also got them broken down here and archived. So for instance, I can go in and I'll show you September. Let me show you one in particular. Again, if it comes up. I actually went into this once before and it was slow, so I'm not sure exactly why. I'm going to try that again. Let's try one more time. But in the September 2nd EB Digest, that was when I mentioned GameStop as potentially the mother of all short squeezes based on the chart list that we, short squeeze chart list that we provide to our members. Or it doesn't look like it wants to come up right now, so just having a little problem there. But normally you can go in and you can look back at the archive of all the EB Digest. But that GME has been on the top of our short squeeze chart list for about 4 or 5 months with a crazy amount of short interest. And by the way, I had a few members email me and providing me links with how a short percentage of float can go above 100%. And essentially what happens is, let's say you have let's say you have 5 different people. Person A buys GameStop. So they've got 100 shares of GameStop at Schwab. Person B wants to short GameStop 100 shares at Schwab. So Schwab lets them borrow the shares. Okay, so we got 100 shares on the long side, 100 shares on the short side. But that same person that borrows the shares at Schwab then sells those shares. What if somebody at TD Ameritrade buys them? Now TD Ameritrade, somebody there owns the 100 shares, and now TD Ameritrade allows them to let somebody else borrow and short. So the same 100 shares potentially can be shorted multiple times. That's how you get above 100%. But what you need to know is that if you get it to 100% or more afloat of shorts out there, that is a lot of shares that have to cover at some point. Those are guaranteed buyers, guaranteed. They are not going to hold a short position until retirement or hand it down to generations. They are going to buy those shares back at some point. And that's the beauty of the short squeeze. And we're going to talk about the short squeeze later. This is, the market is all caught up talking about the short squeeze this week. We've been talking about it for months, and our members have been benefiting from it for months. I've been getting a lot of really positive feedback from members. And the last month has just been crazy. If you've been in any of our short squeeze stocks before last week, I can't even imagine what your account looks like, because some of these short squeeze stocks have just been crazy. I mean, GME is obviously the big one, but there are others that have been doubling and tripling over short periods of time. And I'm talking, a few days to maybe a week or two, which has just been crazy. But again, talk about that a little bit more in just a bit. All right. I'm not sure. I'm looking on the screen and I'm seeing the GME article.
I shared it, Chum.
Oh, okay. Okay, because I'm looking at it and I'm like, that's not even on my screen. This is really weird. Okay, so I appreciate it. But maybe it must be my internet that's slow, maybe. I don't know. Anyhow, this is what I was referring to. So there is if you can scroll up a little bit, Aaron, just to show the date. So there's the earnings beats digest for September 2nd, 2020. This wasn't, Wednesday of this last week. Everybody's coming out, they're genius now. This was something back that we were sharing September 2nd. We knew the potential was there. We didn't know what might trigger it, when it might happen, but I can tell you this, I would never short GME or any stock on our short squeeze chart list because they're already so heavily shorted. You're late to the party if you're trying to short those stocks. You want to check short percentage of float before you short a stock. Because if they're already 20, 30, 40, 50%, if that number is already getting to that level, you're pretty late to the game. And you want to be really careful, really careful. I mean, if GME doesn't scare you on the short side, I don't know what will. I mean, if you shorted 1,000 shares of GME at $7, when it got to the high of 490 or whatever it was, you'd be bankrupt. Many people would be bankrupt. You wouldn't be able to, you couldn't afford it with some of these gap ups. I mean, it's been crazy. You want to know why some of these hedge funds are struggling and why they may go out of business? First of all, they're not doing 1,000 shares. I can promise you, they're doing probably hundreds of thousands of shares. Multiply that times the difference between $7 a share and 490, probably putting them out of business. And maybe, who knows, maybe to the point where literally they can't even possibly cover the debt they owe. So,
Hey, Tom.
Yes.
Yeah, the latest figure as of Thursday, I think, was a combined loss on the shorts, the hedge funds of 100 billion.
Wow. You know what, though? I can go on a rant because I think turnabout's fair play. I mean, I've seen Bill Ackerman take huge short positions in stocks and then go tout it, not taunt, but maybe somewhat taunt, but tout it on CNBC. And then by going on CNBC and saying, hey, I'm Bill Ackerman, I just shorted X percent of this company, the stock gets hammered. It's almost like they get to encourage others to take the position they have. And what do you think that does to the small person who owns the stock?
That's
what do you think
right.
it does to the company?
Yeah.
You
I
know, when
agree.
all of a sudden, it potentially could put them out of business. How many jobs how many jobs do we lose? So now it's a little bit on the other side. Now you got all these small investors kind of ganging up, and look who's on the other side getting hurt by this. Some of these big hedge funds. Hey, you know what? You're going to take a big position on the short side. You got to understand the risk, just like individual investors have to understand their risk. I have very little sympathy for the hedge funds, to be honest. I have very little sympathy for those who short. Stock market goes up more than it goes down. I mean, if you want to spend your time trying to short stocks, that's fine, but I don't understand why you just wouldn't go with the 70 or 80% that are going higher and just be on the long side. But again, that's me personally. I know that there are a lot of folks do a lot of really good trades on the short side, but you do have to be knowledgeable. You have to understand what you're doing. This is going to end poorly, by the way, for those who are jumping into GME and some of these other short stocks at these levels. I was already looking at the GME chart, by the way, and for the last 5 days have filled candles. In other words, if you're not in overnight, you're not getting the move to the upside. I mean, maybe you're trading it intraday with all the crazy swings, but we're closing below the open for the last 5 days. We've closed below the open on GME. So market makers know what's going on. And believe me, they're going to play everyone like a fiddle. Right now, it's the hedge funds, but all the individuals that are jumping in, buying GME at $450 or whatever crazy level they're buying it at, it is not going to end well for them. It's just the way the market works. I would not be doing it. I mean, if you want to get in and trade it, fine. But I'm telling you, you are literally sitting at the roulette wheel in Vegas. And if that's the way you want to invest, that's fine. But that's not, really our style. We'd rather catch these before they make these big breakouts. We don't want to chase these moves on the long side. I think, that's going to come back to haunt us as well. Anyway, I got off on a big tangent there. So I did mention the Earnings Beats Digest. This was just one article, but the digest comes out 3 times a week, Mondays, Wednesdays, and Fridays. We try to get it published before the market opens. Normally, I mean, in this case, GameStop that you're looking at, this was a short squeeze candidate. Sometimes we feature those. Sometimes we feature a company that's going to be reporting earnings soon. Sometimes we report a company that's showing great relative strength and just looks like a really nice stock to own. There's lots of different things, but it's all based on the things that we teach. And hopefully the EB Digest provides our community there with ideas and maybe just some different tools that they can include in their own trading. And then if they get to the point where they say, hey, you know what? I'm getting a lot of really good information from Earnings Beats, hopefully then they'll become subscribers. That's really, kind of how we envision this. But starting out, if you're new to Earnings Beats, you don't really know too much about us, at a minimum, it's a free newsletter. Why not? No credit card required, and you can unsubscribe at any time. And again, you're not going to offend me if you don't want to keep the newsletter. All right, let's keep moving. So that was the free EB Digest. So I want to go into our stock research and education platform. And let's talk about some of these things I just introduced you to. So you should now see, you all can correct me if I'm wrong, Aaron or John, but you should be back to this page with the ETF webinar. But let me go ahead and jump over because I want to get into the daily market report first. So this was Fridays. This comes out every day that the market is open. Even if I'm on vacation, I generally will take time out to write this. Maybe at some point during the year, I'll take a real vacation and not do anything. But I don't know. That's hard for me to do because I'm always looking at the market. Even if I'm on vacation, I'm not going anywhere if I can't look at the stock market. So normally if we have anything, if we update chart lists, if there's been an update to any of our chart lists, we'll mention it at the top. If we have an event like this, we'll mention it at the top. If we're running a membership special, we want to make sure that our members are aware of it. If they don't come to the webinars, we don't want to assume that everybody just knows we have a special going, because every once in a while I'll get a member that'll write back and say, why are you putting these membership specials on the daily market report? Well, it's probably the one piece of, the one email that we send out that gets most of our members' attention. And we want to make sure everyone's aware of it. So you'll see those types of things at the top. But what you'll see every day is an executive market summary. So if you're busy, you don't really have time to follow the market, you may just want to read the bullets and just say, okay, this is what the market's doing today. Here's what's kind of happening, and boom, you're done. Go back to your business and not really worry about things. Or you might continue moving on. Usually I'll do something that, correlates with the market outlook. What do I see out there? Am I bullish? Am I bearish? Am I bullish? If I am bullish, why am I bullish? What are some of the charts that I might show? Here, because the volatility has been on the increase, and you can kind of see that it's been shooting up recently, I wanted to point out that spikes in the VIX, when they do happen, when they top the S&P 500 bottoms, that's what this chart was all about. So you got all these VIX spikes, and they coincide perfectly with all the major bottoms in the market. We're spiking right now. So I don't know where we're going to go on this spike on the VIX. I wrote about this in my Trading Places blog this morning. Got up early to get that out before the event. So you can certainly go back and take a look at that. But we are on the move to the upside. I can tell you this. We have only had trips that have really, trips in the VIX through 55. We've only seen that on 2 occasions in 30 years, I guess, 35 years. I don't know, however long the VIX goes back. 2008, financial crisis, 2020, healthcare crisis. I mean, in both instances, everyone was scared out of their minds. Financial crisis, it was like the banks are going to fail. I mean, everyone's like, what do I do with my cash? I'm going to put it under my mattress. I don't even know. I don't even feel comfortable. There was actually a run on many banks because we didn't think banks were going to survive. That was pretty extreme. In March of 2020, we didn't know what the heck this pandemic, we just started seeing cases popping up around the world. Every news place you go to, it just talked about how many people were dying and being hospitalized. And, and then we had to shut down economies. And it's the unknowns and the extreme fear that drive the VIX to 80 or 90. Like I said, we've seen it twice. Otherwise, outside of those real extremes, I don't believe what we're seeing right now is an extreme. If you're telling me that GME is going to bring the market down, yeah, I don't think so. There aren't that many shorts. Let me just say, as John mentioned, 100 billion sounds like a lot. It is a lot of money. Trust me, there are trillions and trillions and trillions and trillions and trillions of dollars working its way through the market every day. $100 billion is a gnat on an elephant's butt. It's tiny. It makes for great headlines, and I'm not saying that it's not creating problems for certain hedge funds. It is. But to think that that is going to take the toll that this pandemic took or that the financial crisis took, I don't buy it. Maybe I'll be wrong. Maybe there's going to be this huge domino effect that I'm not anticipating. But I don't believe that's the case. Instead, what I think we're looking at is a VIX that is going to top somewhere in this range. 30 to 50 would be my guess. And we hit 37 on Friday. And for those of you who are unfamiliar with the VIX, I don't want to get into a huge definition. You could read my article. It explains it a little bit more. But essentially, VIX is a fear meter. And panic sets in, and these major lows are set when the fear spikes to really high levels. We're in the midst of one of those spikes right now. It's very possible we saw the high in the VIX on Friday. That might be it. My gut tells me we might have one more move to the downside this week. But the other thing I can tell you is look how quickly, when you see these bottoms, look how quickly we recover. If you sell at the height of panic and then have to buy back a week later, many times you're going to buy back a whole lot higher. So if I was already in and I hadn't sold at this point, I would just hold my nose and hold. That's just my own personal opinion. Everybody has to do their own thing. But I think we're close to a bottom if we haven't hit it. I think the 20-week EMA is a possible point on the S&P 500 that we should be looking at. That's right there, the green line. I mean, if you go back and you look, the green line tends to hold during pullbacks. But when the VIX spikes, it can get irrational. The trading can get irrational. So we could miss the bottom by 1 or 2 days, and it could be 7%, because as the VIX spikes, the losses mount. So I don't want to, sugarcoat it too much, because, in the short term, we definitely could see some more significant selling, but I do believe that it won't last and that we will snap back fairly quickly from it. But anyway, that's market outlook. Then I usually will go into sector industry focus. So I talked a little bit about internet stocks and how we've got gap support there. And if that were to fail, we've got a pretty significant level coming in here just above 2,600, maybe even down to 2,600 if you look at some of these other lows. So 2,600 to 2,640. If things really start off bad this week, I think internet could hit that area. So talk about that. Chart list strategies. I'm going to get into the chart lists. But as a result of looking at internet stocks and thinking that, hey, these are a couple of the areas we might want to look at, I then went a step further and said, okay, if we do see a reversal in internet stocks, here are internet stocks that are on some of our key chart lists. The SECL, which is strong earnings chart list, SFECL, strong future earnings chart list, and then RGCL, which is raised guidance chart list. These are 3 different chart lists that house our research. And so we can run scans against those chart lists and bring up some of the best performing internet stocks in this case. All this research is done. Again, I'll walk you through that in just a bit. But here is the list of internet stocks in scooter order, Stock Charts Technical Rank, which is a way to look at these things on a relative basis. Relative strength basis. So there's the list, and here's some of the names that, hey, if internet reverses, these are definitely some of the names that I would be thinking about. I mean, I own Upwork. I've been trading in and out of both Pinterest and Snap. I don't own those currently. I do own Upwork. Looking to see Netflix. I've traded from time to time. Don't think I've owned any of these others, although Farfetch at the top is one certainly to be looking at. But, and then I pull up a couple charts. So Baidu was one that I pulled up here. You can see Baidu just coming down, testing its 20-day. If the market were to completely reverse, this is an area where Baidu could quickly move back to the upside. It's a leader, and it's hitting a key support level. Now, if it fails at the 20, then, maybe you got gap support we've got to worry about, maybe down closer to 208. But from a short-term reward to risk standpoint, potentially you could get in at the 20-day and then have a fairly tight stop if we took out Thursday's low, something like that. And then I also mentioned Upwork, which is, like I said, a stock that I own. It's nearing its 20-day. And I think it came down and closed right about where it was at that point of the day, which was just before. You can see the time stamp on here, 1:53 in the afternoon. So it was just before 2 o'clock. I think I sent out the DMR right around 2 o'clock. But I think it finished pretty close to that level. I don't think it went below 41, but I'm not positive. And then I give you an update on earnings reports. So Friday, give you those, that reported that day, and then also give you the bigger earnings reports that'll be coming up on Monday. Economic reports, give you the actual and the estimate on all of the economic reports that day. So that's your daily market report. Pretty lengthy, gives you some pretty good ideas, and it comes out every day. Next up, weekly portfolio report. Like I said, this goes out on Sundays. I'll be doing this tomorrow morning. First thing I do, and it concentrates on our portfolios. So the good news is, if you're not a member, I'm going to show you our portfolios here in just a second. So that's a little bonus for being in here today. So let's take a look first at the upcoming earnings report. So I just want to let you know, if some of you may do like we do, and we just hold for 90 days. That's our philosophy with our portfolios. And I'll talk about that a little bit more, the philosophy, when I get down to the portfolios. But for now, I just want to show you the stocks within our portfolios that will be reporting earnings in the upcoming week. So this was for last week. So Starbucks, Advanced Micro, Apple, Tesla, EMN, which is a chemical company, Dolby, DLB, and then Desiki, small trucking company, reported on Friday. So those were the ones. So at least you know, if you're holding these stocks, which companies report in the week coming up. You can decide whatever you want to do. Some of our members may hold, some of them may be trading these, might just want to know that, hey, Starbucks, AMD coming up on Tuesday, better check to see what time, and then decide if I want to hold. You know, that's a decision each member has to make. Holding through an earnings report, there's nothing more, I would say there's nothing more volatile other than maybe holding a biotech into an FDA announcement. That would be crazy. Of course, many times you don't know exactly when those are going to come out. But that volatility trumps the earnings. But earnings is a pretty big deal. So if you're a short-term trader, you may love it. You may love the excitement and the, spinning of the roulette wheel. Others that want to, control your risks, you might say, hey, I don't want to take that risk and get out before earnings. That's up to you. But our portfolios, we hold them 90 days. We just provide the information and let our members know. We go through the rules and objectives. This is in every single weekly report. So you can get a general sense of how these were picked and what we do with them and what we don't do with them. We do not include stops for our tracking purposes. And the whole idea, we're trying to be very transparent. We're trying to be very simplistic. We're trying to be very disciplined. And it's really a combination of strong fundamentals and buy and hold meets strong technicals and trading. It's kind of a marriage of all of that, which has done extremely well, by the way, since we've came up with the concept and since we've been providing these quarterly drafts and then tracking the information and so forth. But anyway, you can go through, you can read all that. Weekly snapshot. So every week we're going to tell you what the S&P 500 did, the pandemic index, which I developed during, actually later, but I took the 10 of the worst performing industry groups during the heat of the pandemic, March, April, maybe even into early May, took 10 of the worst, and I put those industry groups in an equal weighted portfolio that I manage at Stock Charts using their user-defined index. And I just want to know how airlines, aerospace, some of the real estate groups, some of those groups that got hammered, recreational services, which includes cruise lines and so forth. These groups that were hammered back then, I want to know when those groups begin to lead. And so one thing we do is we just simply include this pandemic index on here to compare it to the S&P 500. And then here's each of our portfolios to show what they did for the week. So you can quickly look and see, okay, model portfolio, a little bit less than the S&P. Aggressive portfolio absolutely blew the S&P away that's a 1 week return, an average of the 10 stocks. Income portfolio, which was about the same as the S&P, and then strong AD had a good week. Strong AD is accumulation distribution. What I can tell you is that the benchmark was down 3%, 330, something like that, 340, I think. Maybe it was a little bit more. I don't remember. This past week, that'll be out tomorrow morning, like I said. The pandemic index, though, was down about 5%, 4 something, I believe. So the pandemic index, again, took it on the chin more than the S&P. Then I go through weekly summary. So I just tell you something about the S&P 500 usually. In this case, just showing you the weekly information in terms of what areas of the market went up. Then we go into our portfolios. There's the model portfolio. So I tell you how we finished, how we did versus the S&P 500. I show you our inception to date chart every week. One question I get sometimes is, why is this 229% when this says 329? Remember, the model portfolio started with a value of 100. So to get the 329, you're actually up 229%. Okay, that's why I just mentioned that. The S&P 500, their base starts at 0. So 42.77 is the actual percentage. So since this portfolio began, you can see there are the numbers. And that should tie really close. We might be off fractionally, 1 or 2 hundredths of 1%, just based on rounding. But either Abby or Aaron track the results of our portfolios on a daily basis on our website, and I do this. So it's actually a way that we can double check to make sure that our results are correct. So if you're ever looking at this and you see that this number is completely different than what we have on our website, first make sure that the dates are the same. Make sure the website says that it's as of the Friday close. And if it is, then probably send us an email because they shouldn't vary by more than just, like I said, the website might show 229.67%. Should be pretty close. Then we get into how each of our portfolio stocks performed for the last week. So there's our model portfolio right now. Snap, Five9, Advanced Micro Devices, Roku, Tesla, FedEx, Zoom, Crocs, Yeti, and Align Technology. Those are our 10 stocks. They were equal weighted at the beginning of the period. They're not equal weighted anymore. We don't adjust the weightings every day. So they can get out of kilter during the quarter, but then at the end of the quarter, we sell everything and we start off the next quarter equal weighted again. Okay, so those are the portfolio stocks there. Sometimes I'll maybe mention one stock down here or mention a couple of them. If something, if one stock's doing something kind of looks interesting, like Crocs was getting down close to a couple of key support levels after earnings had come out, you can see new information. Buyers stepped in at about 70.5, 71. So that's a pretty key support level. And if we did fall below that, then the prior high was about 68, 68.5. So just highlight a couple of key support levels to watch. Here, you're going to see this on just about every chart we do at Earnings Beats. We have accumulation distribution, and then we look at industry group, stock versus industry group, stock versus S&P 500, industry group versus S&P 500. And when we've got stocks that are going up across the board from left to right, that's telling us we have a leading stock and a leading industry group. That is your visual of having a really good stock in a really good part of the market. And that is the key to outperforming the S&P 500. So you get a bunch of those stocks, not all of them will continue to show relative strength, but some, or maybe in, we're really lucky, many of them, the majority of them will continue to show relative strength and they'll carry our portfolios. All right, I'll go through these a little bit faster. Aggressive portfolio, you can see, again, since inception, where we are. I mean, it's been, the aggressive portfolio has been crazy. And January, 2 of our aggressive portfolio stocks right here, SunPower and Bed Bath & Beyond, are both stocks that are being lit up to the upside because of the short squeezes. So you can see this particular week, I remember I told you we were up 9% on average. Well, SunPower and Bed Bath & Beyond were the main reasons. I mean, we had a couple others did very well also, but those were the primary reasons. Income portfolio, here is the chart and here are the stocks going right down the list. And then, in this case, I showed Apple. Really like this cup handle breakout. Pulled back, I think it finished like 131 or something on Friday, 131, 132. I think this pullback's very viable on Apple. I really like Apple. Strong AD portfolio. There's the performance versus the S&P 500. Again, there's your percentages. And here are your stocks and how they performed last week. So each one of these portfolios has 10 equal weighted stocks. They're all 10 different stocks, by the way. So I've had somebody write to me and say, well, if I get in one of these portfolios, there are only 10 stocks. Can you give me 30 or, can you give me more? Because I want more to diversify. And I just look at it and I'm like, well, we have 3 other portfolios. We have 40 stocks. If you really want 40, look at all 4 portfolios. Or if you want some kind of a mix and match of the portfolios, go ahead and do that. One thing you'll see, though, is that in each of these portfolios, here, one semiconductor, one renewable energy company, one software company, one recreational product company, one heavy construction. We don't have, I'm not putting 10 software stocks in one portfolio. That would be dangerous. But, you look, we're going to definitely weight our portfolios towards those sectors that perform well in a secular bull market. So that's why you're going to see technology, discretionary, industrials, communication services, and lately hasn't been financials, but in this next quarter, financials have started to turn around. And if they continue to show strength right up through February 19th, there's a chance we're going to see some more financials in our portfolios in the next quarter. We just let the market tell us. We don't try to tell the market what to do. We let the market tell us what to do. And that way you're never, trying to fight Wall Street. When you're on the other side of Wall Street, you're just not going to win. And I think that's part of one of the biggest mistakes that we make. I've had some members write to me about Tesla, and one in particular just wrote to me this week and said, kind of when the light bulb went off was when he realized that being short Tesla was the wrong side of the trade. That he couldn't understand. The market kept telling him that it was worth more than what he thought. And so he kept shorting, and the market just runs you over. And I learned my lesson with Amazon. I never owned Amazon during that whole move to the upside. The CPA in me just said, the company keeps losing money. I can't invest in this company. Their revenues are going through the roof, but they keep losing money. Wall Street was telling me the whole time to get in, and I ignored Wall Street. In fact, I just said, not interested. And it cost me a lot of money along the way, not owning Amazon. We didn't make that mistake with Tesla. I can promise you, Tesla's been in our model portfolio the last 4 quarters. It has been one of the big reasons why we have done what we've done, because we let Wall Street tell us. And there was a chart there on NVIDIA. Then I do a quick little summary about what happened. Now, currently, like right now, I put in model ETF portfolio. Eventually, this is going to go into its own monthly ETF report that I talked about earlier. We haven't started that yet, but I'm going to update the model ETF portfolio on a monthly basis. There's no reason to get into ETFs on a week-by-week basis, not for what we're doing with these portfolios. So that'll get moved off of this weekly portfolio report, and it'll be on its own report in time. And there are our current model ETF portfolio ETFs. And we've also got percentages in there. We let our folks know what our percentages are. And all of this was announced back on January 19th. All right, so that's our weekly portfolio report. I try to get it out by noon, not always, but I try to get it out by noon on Sunday. I mean, if I've got something I'm doing personally and I can't get to it, sometimes this will come out in the evening. But it does come out on Sundays. And so you have it, you can read it, look at it before the market opens on Monday morning. The monthly seasonality report. So for January, first thing I did is went back and looked at December to see the stocks, where they were on November 30th, where they were on December 31st, and figuring out their gain, and then just seeing how they perform. November, we had a great month. December was so-so. I haven't even looked to summarize January yet, but that'll be a report that should come out tomorrow as well. But if you look back at December, it'll show you, okay, Western Digital gained 23% in December. So it definitely kind of followed its seasonal pattern. And by the way, Western Digital was the #1 stock in our list. It was the highest ranked stock in our list. We list them by average December return. So all of the chart lists, and when I get into it, I'll show you, the chart lists for the seasonality are listed in terms of their percentage return, average percentage return for that month. And WDC was the #1. So anyway, there's all the performance. You can see 3 actually lost ground, even though they typically do well in December. So this isn't a guarantee. This is providing you more information, more knowledge about the stocks you own or that you're considering owning. You might look at WDC going into December and say, wow, I really like the chart. And, oh, it also loves the month of December. Reason to feel confident about that trade. Doesn't mean it's going to go up. It's just another signal that kind of lines up on the bullish side. It's good to have the information. So then I talk a little about it. Here was the chart on Western Digital. And then a look ahead at January. So get into the S&P 500 performance. We try to break that down for you. So check this out. January 1st to the 18th, the S&P 500 on an annualized basis has gained 35% since 1950. January 19th to the 31st, minus 3.21%. If you're wondering why that would be, earnings. The market generally moves higher heading into earnings. Buy on rumor. After the earnings start coming out, sell on news. What did we just see this past week? Selling. I mean, this was information provided at the beginning of January. And it, so any interesting seasonal facts that I can come up with, and there probably aren't too many folks out there, maybe the Hirsch's with the Trader's Almanac, they probably have more stats than me, but not too many folks have more stats. I keep pretty close look at his history and what's taken place in the past. And so I share that information in this report. And then I even mentioned the stock market has a long-term tendency to perform exceptionally well heading into earnings season. The 18th of January is roughly the time that the big banks kick off earnings season. And I mean, we topped almost right on cue. Sector performance. So I do what I call these heat maps. So there you can see sector heat map. This just tells you all of the sectors, how they perform relative to the S&P 500. So that's critical. This isn't just the group, how it performs, but it's on a relative basis. So right down here, the numbers reflect how much a sector on average outperforms or underperforms the S&P 500 over the last 10 years. So, and the reason I picked 10 years, the market's been going up for 10 years. So by using, I could go back 20 years, but then I'm including 10 years of a bear market. I believe we're in a secular bull market. I think it's much more meaningful to know how these groups do during a bull market than including half of the period being in a secular bear market. So this is what we look for. Look where the green is. The green means we outperform. The dark green means we really outperform. All of the aggressive sectors. Neutral sectors, not so much. Defensive sectors, kind of mixed. A little bit of strength in real estate and utilities in January. But anyway, some really good information. Then we get into industry performance. What areas of the market? You know, we talked about communication services and technology up here. They were the two best in the aggressive areas. So I wanted to go back and look at these two sectors, and I've pulled up all the industry groups and shown you where the industry groups tend, which ones tend to do very well relative to the S&P 500. And then I go on outside of those two sectors, and I mention in these three areas, which are the other three aggressive areas, these are also groups that tend to perform well. Then we get into stock performance. So we try to pick the top 20 seasonal stocks for that month. So here we pick the top 20 seasonal stocks for January from the S&P 500 and NASDAQ 100. I mean, we can't go out through all the stocks in the market. There are thousands. It would take us forever. But the S&P 500 and NASDAQ 100 is a pretty good start. 600 of the largest companies, probably many of these companies are the ones most folks trade. And so in January, here was the list of individual stocks. And we presented a chart list to our members so they can download it right into their account, keep track of it. And then I mentioned one interesting fact, and I haven't even followed up to see if this held true in January of this year. I've said I probably would jinx it, but HII over the last 12 years had been up all 12 years in January. 100% of Januaries it's gone up to the tune of an average return of 5.4%. Now I have to come over here and take a look at it. I mean, with the market selling off, I'm assuming it didn't. Nope, went down. First time, I knew I was going to jinx it. But yeah, it had been up 12 straight years in the month of January. So now next year when we pull this up, it'll be 12 out of 13. So this will be, I don't know, 92% or whatever 12 divided by 13 is. Anyway, so that was just an interesting chart that I shared. And then, oh, this is just a second one. I don't know why it posted, or is that the one before? No, that was the same one. Yeah, so I think it just posted twice. Anyway, it's the same report. But that's a pretty lengthy report. That comes out once a month. The monthly short report. This is the one, I'm telling you, if anybody acted on this one when this came out in January and you just decided, okay, I'll just take a shot with some of these. And I always say, listen, if you're gonna trade the short squeeze chart list, you can get a lot of excitement with a little bit of shares. You know, if you normally would go out and put $10,000 into a stock, I would not put 10,000 into one of these, maybe 3,000. You don't need 10,000 to get the kind of return. And the thing is, you say, well, if the return's great, I want to have more in it. Well, the problem is that these stocks also tend to be very volatile to the downside. You can't just go into a stock and say, wow, look at all the money I can make. You have to at least take a step back and say, how much money could I lose? And I think that a lot of folks aren't considering that right now. A lot of these Robinhood traders that are jumping into GME, they're thinking about how much money they're going to make. I've been there. I learned my lesson long time ago. And I continue to learn lessons. I mean, I learn lessons every day in the market, slapping my hands left and right. But these stocks can be very volatile. As you just saw, I mean, GME went up to 400 or whatever, and the next day hit a low of 112. If you got in at the high, you saw 70%, 75% of your money gone in 24 hours. You know, if you've ever done something like that, I've done it because I've been in options before. I've seen it with options, which I don't trade options anymore. I know my limits in trading. I tend to have a little bit more of an aggressive side to me personally. You might not see that at stock charts as member or at earnings beats as a member of earnings beats. But I do. And I know that options is not good for me. Because if I leverage and start making money, then my confidence grows. And maybe some of you've done the same thing, but you start taking bigger bets than you should. And so I've gotten much more disciplined. I know my weaknesses, and I think it's important everybody, really understands their demons inside and tries not to let them out. But anyway, in this report, here are the hot stocks. So AWH, PGEN, DDDS, Fubo, Stitch Fix, Chewy, Nordstrom's, GameStop, SunPower, and Big Five Sporting Goods Corp. These were 10 stocks that I ran a scan. So I showed exactly how I came up with it. I ran a scan against our our short squeeze chart list. And the scan was looking for stocks with daily PPOs greater than 5. Now, the significance there is that that's a lot of positive momentum. That means the stock's moving higher. In order to get your PPO up to 5, you've got to be moving. And with scooter scores above 90, telling us that they've got strong relative strength. Now, if you know that you got momentum and you know you've got relative strength and you know you've got a stock that is got a lot of shorts that have to be, kind of like on pins and needles. Think about back in March, if you were long the market and it kept going down. You remember those days you wake up and Dow futures down 1,700 and you're like, do I sell everything? What do I do? Well, shorts, when you see the price action keep moving up, it's even worse if you're on the short side. Because if you buy GameStop 1,000 shares at 7, the most you can lose is $7,000. Now your gains are unlimited, but the most you can lose is 7,000. Think about the shorts. They short 1,000 shares. The most they can make is $7,000. The losses are unlimited. And that's what we're seeing with GME. All of a sudden, if you were being stubborn and you were sitting on 1,000 shares of GME short at $7, and you're just like, oh, I'm going to play this out. I'm going to prove to the market I'm right. Well, that's all great, but right now you owe, I don't know, 300, and I don't even know where GME, it's been dizzying. 300,000, 400,000 is what you would owe on that. I mean, that would be financial ruin for a lot of people. Even these hedge funds that have all this money, shorting leaves you exposed much more than being on the long side. So keep that in mind. I'm going to pull up a couple of these charts in just a minute. But here was AWH. So this is a biotech. I wanted to point one of them out here and some of the things to look for in a short squeeze. First thing, you've got to trigger somebody's emotions to want to cover. If the stock's been going down for 3 or 4 months and you have a couple of days to the upside, that's not going to trigger any panic. I mean, if you're in a stock, let's say you're in Apple and it's gone from, you bought it at 100, and so it's gone up to 130, 140, or let's say you wrote it up to 140. Are you going to panic when it drops to 131? I don't think so. But what if it dropped below 100? What if it dropped below 70? What if it dropped below 40? I mean, there's a point at which you just say, hey, I can't take the pain anymore. I'm getting out. Same thing applies to the shorts, except the excitement is even more to the upside, because it's almost like, and the analogy I use with short selling is just imagine a packed movie theater. I mean, packed. And there's one door at the bottom in the lower right-hand corner, and somebody yells fire or bomb or whatever. Imagine everybody trying to squeeze through that little door all at once. That is that, and the pandemonium and the panic. That is what shorts face when they start seeing breakouts. So I don't want to buy. I don't want to be in a short stock when it's trending down. There's no incentive for the short squeeze to kick in. The incentive is when you start moving up. And you start to see the effect of the short squeeze when the volume begins to pick up. Now, the other thing you can do is you can click on the chart. It'll give you an update. Now, look at what AWH has done. So we broke out above $575, went sideways a little bit to 575, and then broke out again. Now, look at the volume picking up. I can promise you this is some short squeeze activity taking place. It's the combination: breaking out, taking out prior highs, volume expanding. Those are the traits of a short squeeze. And when they start going up, they can just quickly escalate to the upside, because there's a lot of folks losing money and they have no way to get rid of the pain except to buy. They've got to cover their shorts, or they just take the risk of it going up, 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 up. Now, AWH isn't GME, but who's to say it's not going to be another? Well, probably nothing's going to be like GME. Like I said, the level of short interest in GME was crazy, and I'll show you that in just a bit. But AWH, you can see, was a pretty darn good short candidate. So let me go back over here. All right, so I can get rid of that. So that was the one that we featured on that list, but there were plenty of others. Recent winners on our list. And so I even, was trying to provide a little education. Some of the things to look for. SunPower. Not only is it in our aggressive portfolio, but they also beat their earnings estimates. So they're on our strong earnings chart list. And they're heavily shorted. So when the stock began to break out, it's got good earnings. It's showing great relative strength. And if you're wondering about the relative strength, here you go. This is what I was talking about. See how everything's going up from left to right? I mean, it's a good stock, or really good stock, in a really good industry group. Renewable energy has been crushing the S&P 500. SunPower has been crushing renewable energy. You've got one of the best stocks in one of the best industry groups. And you've got a lot of short interest. So when it started breaking out, look at the volume picking up. It has been just unbelievable. You want an update? That was as of December 31st when we issued our monthly short report. Look at where it went now. Look at the volume. they're scrambling. The shorts are scrambling all over one another to get out. It's just a buy fest. That's how a short squeeze works. All right, Blink was another one. So Blink, look at how it takes out this prior high. I mean, again, that's when the panic triggers. Here we had some pretty good moves on some decent volume, one day in particular. I mean, here when we made a move up, there's no volume, and that's not a short squeeze. A short squeeze requires volume. You've got to get those short sellers to sell, and there's a lot of them. This was a short squeeze. Do you see the difference between this move and this move? This move, we went from 12.5 to 35 in 5 trading days. I mean, normally in a normal stock, if you could get a stock to go up 180% over 5 years, you'd be ecstatic. This stock did it in 5 days. 5 days. And then settles back down again. And then what happens when it breaks out again? Right there. Now, could you have bought on the 20-day? Yeah, you could buy on the 20-day. I tend to avoid trading short squeeze stocks based on my normal techniques, which would include buying on a 20-day test. I mean, if you bought on the 20-day test and it didn't hold, I'd get out. Because these stocks being heavily shorted, normally a stock that's being heavily shorted is being shorted for good reason. Not all of our short squeeze stocks are taking off like the ones I'm showing you. You need that strength. You need to see these stocks. And that's why, again, at the top, I was looking for stocks with daily PPOs greater than 5. You don't get daily PPOs greater than 5 when you're trending down. PPOs are negative. This one would have triggered on this list probably about here. So that would have been maybe the time to start looking at it. But if you wanted to wait until you got a breakout, you certainly could do that on the stock. So there, and you can see right now, PPO is up 10, or it was. Now it's probably a lot higher than that. Okay, so just, okay, so there's Blink. Nope. All right, there's Blink. So there's that breakout. There's another breakout. This breakout, say $35. It went up to 57.5 in maybe 6 trading days. I mean, do you see how fast these move? It's almost hard for me personally to hold them that long, because if I get in at 35, I mean, I'm just accustomed to taking a 10% profit. So if I get in 35 and later that afternoon it's at 38, a lot of times I'm gone. I'm not there 5 days later for the trip to 57. That's just me personally. It's hard for me to turn a quick 10% profit a day or two away. But others, are different style traders and so forth. And I've tried to adapt and I've tried to adjust, and it's still difficult for me to hold a long period of time on these short squeeze charts. All right, so then I went on, watched these recent breakouts and setups. So here, that's another beautiful thing here with this short report, is that I'm not just telling you what happened last month or whatever. I'm also giving you some setups. So Michael's big move up, breaking out. Look at this PPO, went up all the way to 10 and it's pulled back. At this point, it was at 486. So it didn't get included on the list that I showed you at the top. Why? Because I was only picking PPOs that were greater than 5. This is 486. But it's still looking good. So what did MIK do? Well, there's the chart, and look at the breakout. I mean, the volume picking up. It's in a short squeeze. Again, do you want to buy on the 20-day? If you want to, that's fine. It may work. It may go back down, test the support area. One thing to understand about these stocks is that they're very volatile. If you are somebody that has problems sleeping at night, worrying about your stock going up 5 or 10%, do not get into these short squeeze. I mean, we try to be really honest about the risks involved in various trades. And, I get a question sometimes, why don't we tell our members what to buy and when to sell them? The problem is every member's got a different risk tolerance. So for us to try to figure out whether a stock is the right stock for member A versus member Z, we don't even know your financial situation. I think it's irresponsible it would be irresponsible. We used to actually do trade alerts and we got away from them. I couldn't even sleep at night knowing my members were getting into some of these if they didn't work out. I'm thinking, what if somebody, you know, is on fixed income in retirement and I just lost them some of their money? I can't make that choice for everybody by issuing a blanket trade alert to our entire membership. So that's why we don't do that. We don't, and this is probably the even bigger reason, we're not registered investment advisors. We don't recommend anything. The words I don't like to use at earnings beats are recommend and advise. Suggest is better. Educate's the best. I really like just whatever I talk about, I hope is providing education. I hope coming in here, if you look at MIK, you don't hear Tom saying buy MIK. What I hope you hear Tom saying is that this is what a short squeeze looks like. This is how you can identify a short squeeze that might work versus one that might not. So that's MIK. Look at DDS. This one was a Earnings Beats Digest newsletter. Actually, MIK may have been as well. But DDS was mentioned. See that ascending triangle? When it broke, that's when I mentioned it in the EB Digest. So it was probably sometime late November, early December. But this stock was at 63.05. And its PPO is above 5, so it is on the list up above. But look at the chart now. I mean, it's just gone crazy. This chart list, we update it every month and send it to our members. You will always know at Earnings Beats what the top shorted stocks are from that chart list. Pretty cool.
Hey, Tom.
Yeah.
I know we normally hold off for questions at the end, but I've had a number of people asking where you find the information on short interest in a given stock.
Well, you can get it at NASDAQ. I mean, it's data. So in most areas, you have to pay for it. So it's obviously better to get it from us than to have to go out and spend. I mean, I don't know if you're a Stock Charts member, Chip Anderson, the president, he talks about this a lot. Data is very expensive, and Stock Charts goes through this all the time. I know, folks like you that probably are members at Stock Charts and me, would love to have all this data over at Stock Charts, but the amount of money that they have to spend in order to supply large numbers of folks with all this data, the costs are astronomical. And that's why I think they even have different pricing structures, depending. It's almost like a la carte over at Stock Charts, depending on what you want, because they have to come out of pocket for it. So they don't want to charge people who aren't using it. And so I would just say that, I mean, continue to follow our list, because if you go out and you purchase it separately, you're going to pay quite a bit for it. I mean, if you want to look at an individual stock, you could go to finance.yahoo.com. And when you get to the quote box, put in your ticker symbol. And when the ticker symbol comes up, find the link to statistics, and it'll be on that page. So finance.yahoo.com, type in your symbol in the box provided. And then when that quote comes up for that company, look on the page. I think it's highlighted in blue. But you'll see you'll see a number of different links. One of them is statistics. Click on the statistics and just scroll down till you find it. But they provide short percentage of float. All right, let's go back over to the report. Actually, I think I'm done with this report. Okay. Oh, I did mention, by the way, down here at the bottom. So I mentioned DDS on November 30th. So I figured it was right around the end of November. I remember doing the whole triangle. So you got a bullish pattern. And then when we broke out, we got a little bit of volume. I mean, look at the volume here. Even with this move, I wasn't convinced that the short covering had even begun. And now when you see the latest push to the upside, look at the volume. Again, there's your indication that shorts are being squeezed. I mean, imagine you're on the short side, unlimited risk, and you see this. How long are you going to watch your money go absolutely flying away? I mean, it's exciting to make this kind of money on the long side, but short sellers on the other side. Imagine the feeling in your gut, knowing that you had maybe 200 shares short at 55. So you maybe shorted $11,000 worth. And when it got to 130 or close to 130, you owed 26,000 on that $10,000 or $11,000 investment. That's not going to be a very good feeling, and that's what shorts feel. So is it a, are they sitting there making a calculated decision? I'm going to cover. No, they're getting scared out of their mind. They're panicking. One day it's at 85, the next day it's 105, the next day it's 130. They're just watching their losses escalate and volumes picking up. What do you do? What do you do? Same thing the longs went through back in March, just the opposite. And like I said, you can lose more. I mean, you can ruin your entire financial future, or if you're a hedge fund, you can take your whole hedge fund down. Got to be careful on the short side. Okay. I spent a little bit more time on that just because so many questions come in on the short squeeze. And I think that is a big, big, valuable piece of what we provide our members. Okay, chart list. This is a big deal. There's a video that we have there just talking a little bit about how you can download, how easy it is. I actually have not updated the latest chart lists that we just updated yesterday. So they've been updated. If you look at the last update, the strong earnings chart list was just updated. I got to update the AD, and I'll be getting that probably early next week. It's been a little while on that one. Short squeeze, this was updated a week ago, so that's fairly current. The strong future earnings, last update yesterday, and raised guidance, again, was just updated yesterday. So what I'm going to do is just show you how you can download these into your account. And then we'll pull them up and I'll show you a little bit about what we can do with this. Now, first thing is, and I think what I'll do is I'm going to go over here and sign out of stock charts. And the reason I'm going to sign out is if you're not a member at stock charts, or if you are a member at stock charts and you're not signed in, when you go in here to download this, I'll show you what it's going to look like. So before you click on the link, make sure that you have highlighted and copied the password. You're going to need that. And one question we get a lot is, my password's not working, because members are trying to use their password to get into our website or their password at stock charts. That's not the password. The password, we provide it right after the link. This is a unique password for each of these various chart lists. So I just copied that. Now the strong earnings chart list, and I'm going to put in the password and unlock the list. Now, see how I got this add? And I'm going to save it to a chart list. It's giving me this free 1-month trial. Why? I'm not logged into stock charts. If you're a member, you need to be logged in. If you're a non-member, then you can view the chart list, but I can tell you right now, there's 200 and some charts. I don't remember what the total was. 200 and some charts on this chart list, and we have as many as almost 500, which is the max number. We've been right up against that 500 limit before. So if you're not a member at stock charts, and you need to be at least an extra member, because if you're a basic member, you only get one chart list, and that's your default chart list. You can't download anything from us. If you're an extra member, I believe you get 250 chart lists. And I think if you're a pro member, I believe you get 350. So the difference between basic membership and extra is $10 a month. If you're involved in the stock market and you can't go up that extra $10, I don't know what to tell you. It is worth it, especially if you're a member of Earnings Beats. So pay it. Pay the $25 a month to stock charts and if you have a lot of chart lists yourself, you might want to go all the way up to the pro, $350, to get those extra 100 chart lists. But I can't imagine being involved in the stock market ever again without stock charts. The chart list feature by itself is amazing because I can store all of my research. And now they've given me the ability to provide you links where you can take it into your account immediately, which is so cool. But anyway, this is what you're going to get. You're going to see ads, and you're going to have to scroll through the list one at a time. So imagine this. You can't scan against it. And if I've got 500 charts and you're doing this, imagine, what, are you going to do this every day, you know, to go through and look at charts like this one at a time? I mean, you've got to use the scan feature against the chart list, which I'll show you in just a little bit. So that's what this would look like without being logged in. Okay. Now I'm going to go back here. And first, let me log back in to my account. Okay, so now I'm logged in. And now I don't know if it'll require me, since I've already been into it, I don't know if it'll require me to put the password in again, but I'll copy it and just see what happens here. Nope. Okay, so, and I'll show you on the other ones because I haven't downloaded those. But I would have to input my password just like I did the first time. And then it would bring me to this page. See how this is different? Already it's different because you don't see any ads. Why don't you see ads? Because you're logged into stock charts. Okay. Now, the other difference is, instead of getting an ad to come up to join for a 30-day trial, when I click on the save to chart list, I'm going to be able to save a chart list. I'm going to get this come up. So if I just wanted to, if I'm new to earnings beats and I've never been in here before and I'm saving this, maybe well, I could use like 101. Maybe you want to do chart list and call it strong earnings. 101 strong earnings, new list, hit that save results button. Okay. But I don't want to do that, because I already have a chart list. I've already got a strong earnings chart list. So I just want to replace the one I already have. So if you're already a member at Stock Charts or at Earnings Beats, and you've already downloaded the strong earnings into your chart or Stock Charts account, you can now replace the list. So I'll go in here and hit replace list. I've got to go down and find my strong earnings chart list, which is right here. And now when I save results, this is going to overwrite what I had in there before. Now, if you don't want to overwrite it, then you want to set up a new list. Now, if you merge it, the problem is, first of all, if you've had 330 last time and now you got 230 added together, that's 560, and the chart list only holds 500. I don't even know what stock charts will do, but it'll probably tell you, probably give you some kind of a warning signal that you have too many charts. The other thing that you would do by merging with another list is, let's say I have Apple in one list and I add to it Apple in another list. I'm going to have Apple on there twice. So I'm just replacing. I don't need the old earnings list. So I'm just going to save results, and literally, usually just within a few seconds, it is updated. And there it is. So successfully saved. Now I can view my chart list. So I can pull this up, and there's my chart list. Strong earnings, just updated. And I can tell you by the edit feature how many charts or how many stocks are in here. 232 out of 500. You can go up to 500. Next time when we update the strong earnings chart list, there might be 316. And you just upload it and overwrite. Now, the key is, once you get these into your accounts, that's where the fun begins. Now, I'll show you, first of all, this is the one of the chart lists where I will annotate. So the strong earnings chart list, the way these stocks get into the strong earnings chart list is I go to Zacks.com and I scan through all of the earnings beats every day. And then I look at the revenue beats every day. And any company that is on both of those lists is a company that potentially will go on this chart list. They beat top line, they beat bottom line. Matching estimates doesn't count. Raising guidance doesn't count. You've got to beat. Management has got to over deliver. That's the way you should be looking at this strong earnings chart list. They promised Wall Street these two numbers, and they beat them. That's step one. Step two, I look at the chart. If I like the chart in some way, maybe it's, a nice uptrend. Maybe it's relative strength that I like. Maybe it's the group. You know, this stock's in the heavy construction group, which has been very strong relative to the S&P. This one's uptrending. So I included it. The last test is the liquidity test. I always look at the volume, and I usually eyeball it. I don't run a scan to make sure that the average volume is X. I eyeball it. And if I believe that the average volume is at least a couple 100,000 shares, then I believe it's liquid enough for our members. If I look at it and I see a number of days where it's traded at 100,000 or less than 100,000, has a couple of spikes up to 600,000, I generally will not include it. Because if the stock starts to fall apart and we've got a number of members that are in the stock and the volume is only 50,000 shares and now all of a sudden our members want to get out, I don't want our members to be in that position. So that's why we want to make sure not just liquid enough for me to trade, but liquid enough for our membership to consider trading. And so that's why we just kind of use that threshold. And to be honest, if it looks like it's about 200,000, a lot of times I'll just delete it. I'll ignore it. So probably the average of most of them that you're going to see on here is probably above the 200,000 level, probably more like 250 to 300,000 and up. All right, what else can we do? So let me get back out of that. Let's go back here. Okay, so if we go into summary form, I mean, you can try all these different drop downs, 10 per page, gallery view. Candle glance is kind of cool. And I'll show you that because if you go into candle glance, you can pull up 30 stocks at once. And then you just go to the next 30. And then to the next 30 and so forth. But you can look at them very quickly in this thumbnail, or not really a thumbnail, but a smaller picture here. But you can just kind of look, okay, this one, JD just broke out, went above 100, pulled back. Maybe you like the 50-day test. Maybe JD something you'd be interested in. Maybe Palo Alto Networks, pulling back, hitting its 50-day. There's Aqua, AQUA, testing the 50-day. I mean, there's all kinds of different things you might look at and might be your own style. Maybe there's a major support level that's being tested. Maybe look at something like NVIDIA and you see all these lows down here around 500 and you notice it's getting down to 519. Maybe, you want to take a look. You can do that really quick with the candle glance. Seasonality is interesting, but the problem I have here is you can only do it one at a time. So you got multiple charts and it's also on a 5-year default. So if I wanted to go back to, to the max, I've got to do this for every chart individually. It makes it a little tougher. If it's a stock that I'm interested in owning, then you should be able to go into the summary. And let's say it's NEO that you wanted to look. This is also this symbol right here, this little snowflake, that's seasonality. So you don't have to scroll through that entire list to find NEO. Just come right in here to the summary, click on NEO. And seasonality, well, it only goes back 4 years because it's only been out 4 years. But that's a way you can quickly zero in on something like that. The other thing is here in the summary view, you could do percentage change. All right. So I can be looking and see what's working today on the strong earnings chart list. Or you might say what's not working and look at the chart to see whether or not, Beezer, what happened? Wow, on the annotated chart, it's coming down right to where it broke out from. Now you might say, well, yeah, but it's really picking up volume. Maybe I'm not interested, lost a 20-day. Or maybe you say, you know what? I'll buy half at this support level. I'll buy half at this support level if it hits, and I'll have a stop below. Close below 14, I'm out. All I'm doing by putting in these support levels is I'm just eyeballing. And key levels, you may disagree with me, which is fine. You might say, well, I think support is, at this prior high. So you could go in and annotate and drop that line down a little bit to reach that January 8th high. The breakout, you might be looking at that more short term as the key support. That's fine. You might be waiting for the 50-day test. That's fine. I'm just putting on there a couple of levels that I find, I see this double bottom right here. I think that's kind of interesting. the breakout on volume. That's really the most interesting for me on Beazer Homes is right there. If I see us open at 1650 on Monday, go down to 1540 intraday and come back up and close above 1650 and put in a nice hammer right at that support level, that would be, for me anyway, a technical signal to possibly buy the stock. So it's just a visual having these support levels on here. But what about, instead of intraday, how about for the last week? Now, these are all solid earnings companies, and they've lost, Teradyne's lost 17% in the last week. Maybe that's a great stock to consider. Or what's been going on for the last month? Not as many over the last month because the market was pretty bullish. But Alcoa, 18% down the last month. Is that a buy? All of those things. But let's go back. Actually, let's go back to that intraday, or end of day is fine. And so let's say this is where I think the beauty of what we do and what Stock Charts does really comes into play. Let's say that we've been looking and we believe that internet stocks have reached a key support level. If you go into this search table and type in internet, it'll show you the stocks that are on the strong earnings chart list that are in the internet space. Now you might say, well, where's Pinterest and where's Snap and where's Upwork? Well, the strong earnings chart list, we eliminate companies as they approach their earnings. So those are all companies that are going to be reporting earnings probably over the next couple of weeks. So if you don't see it on here, it just got removed. However, we'll go on to the next list, because the next chart list, the strong future earnings chart list, includes any stocks in strong industry. Well, actually, it includes any stocks in strong industry groups that have scooter scores, I believe, above 80. And then it includes stocks in any other industry group that has a scooter score above 95. So if it's in a really weak industry group, it's going to have a very strong scooter score to be picked up on this scan. But let's again copy my password and then click on this. And now I'm going to paste my password, unblock the list. And I'm going to come in here, save to my chart list. I'm going to replace, and I'm going to go down and find my strong future earnings chart list, and I'm going to save results. So all the time that I spend putting all of this together and getting the links and having, Aaron or Abby putting the links on the website for everyone, all of that research and all the work to coordinate that to get this to you, literally, when we tell you it's updated, you come in and within seconds, it's done. Now you've got strong future earnings. Now, there shouldn't be any stock on the strong earnings chart list that's also on the strong future earnings chart list. And the way you can tell this is if you run a scan against both chart lists. So I've just updated both these chart lists. So I'm going to go down and grab both chart lists. So I'm first strong earnings, add, and then strong future earnings and add. Okay. Now, if I say, give me all the stocks that are on this chart list, strong earnings chart list, and the strong future earnings, it's got to be on both. That's what and is telling us. If I run this scan, 0. There are none. Now, if I ran this as or, it would give us the stocks in both chart lists added together. Run that scan. 578. So if you added them up, both those chart lists, let's see, 346 and 243, that's 589. So there's 11 that's not on here. Now that's interesting. I would have thought it would have been 589. That might be a question for stock charts. I'm not sure why it wouldn't pick all of them up. Maybe I'm just not thinking about it enough, but yeah, it should be picking up both of them. But anyway, see, but when I do the and, there's none that's on both. So they should technically be 0. I'm wondering maybe if the numbers, maybe let's go back here. So the edit. So 232 is the strong earnings. 232. And then strong future earnings 346. Yeah, oh, maybe that's the difference. 346. Did I just add them wrong? $346. 346 and 232. Okay, I think I added the other one. 346, 232. So that's 578. That is 578, which I think is the number that came up on that scan. Yeah. So it hits. I didn't pick up the right numbers. I think I picked up a different number when I was adding the two chart lists together. Anyhow, so that worked. But you can see how you can use scans of chart lists against one another, which is kind of cool, because I haven't showed you the raised guidance, but what if strong future earnings? Okay, let's just consider strong future earnings for a second. And so these are not stocks that are on the strong earnings chart list, but these are strong stocks, technically, that are not on the strong earnings chart list. And let's say we want to run this against raised guidance. So we want to know which one of these strong future earnings stocks has also raised guidance. So I would add the raised guidance chart list here, run scan, 75 of them. We could sort it real quick in scooter order. 99 down to 80. Now, what's interesting is there's not a single stock on here with a scooter below 80. And you know why? Because like I said, that strong future earnings chart list only picks up companies, even the weakest industries, or even the strongest industries, we only go down to a scooter of 80. So now Monday, you'll see them below 80 because we'll have trading that'll be taking place. And so stocks may have their scooter scores being lowered as a result of future trading. But at the time we select them, every one of these are going to have scooters above 80. And you might even concentrate maybe on the top ones. These are companies that look good technically and have also raised guidance. Look at one of the short squeeze chart lists, 3D. That's on there. Remember, that stock went from about $12 to $30 in one day when they came out recently with earnings, or maybe it was maybe when they raised their guidance. So just knowing when a company raises guidance that it's on a short squeeze chart list, pretty impressive. All right, what else do we have here that I can share on these chart lists? So gone through strong earnings. Let me pull up the raised guidance. I'm going to copy that into this account. Copy. And then come over here to replace list. I mean, this is a lot of work. We spend many, 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 many hours putting this together. And literally, you can just come in here and just click on it. It's in your account. And you may have your own way of using these lists to find your candidates. You may have your own scans that you run, and you may just use it against our research platform, which I think is really cool. Okay, so that one's safe. So now I've updated that. And raised guidance, what I'll do, let me show you this. I'm going to pull up this raised guidance in here. Okay, so if we edit the list, this will show you the order. Now, what we do is when a company raises guidance, like the next company this next week, when we update this, the next company that I pick up will be numbered 0626. And let's just say it's Apple, Apple AAPL. And then I put the date when they will report. And these report dates I get from, if you go to the symbol summary, SWK, 429 BMO right there before market opens. That's where the information comes from. Now, I would not rely on that being necessarily the exact date, because companies can come back later and change their earnings dates. But it'll give you a sense of when they're going to report. So as you're getting close, you may want to check it. But that's what, all of this is. Now, if you go back to the top, you'll see gaps, 213, 217, 218, 19, 223. Why are there gaps? Well, any companies that these obviously were raised guidance a while ago, and once their earnings date has passed, or even if it's kind of just about ready to pass, I'll take them off of here. So number 214, whatever it was, probably had a report earnings date in January. So this may have been raised guidance from back in December or even in November. And when I looked it up, the earnings date was January 27th. So that would have been number 214. Well, when we update the raised guidance, I go through here and I delete anything that's old. Okay. Another thing we've had members mention is that we have duplicates on our raised guidance chart list. Well, if we sort, can't do it on here, but if we go to summary, we can sort by symbol. And so you could go down and eventually you'll probably find there's ALB twice. But notice there's two different numbers. They raised guidance twice. I think that's important to know. So we don't want to get rid of the old one just because we added a new one. We want to know that during this quarter, ALB has raised their guidance twice. That's kind of a big deal. Management's pretty bullish if they're raising guidance twice. Pretty good stock. And look at it's come down quite a bit. This breakout area is right around the 150. I mean, if we get some market selling this week, maybe this is a stock you can get in the low 150s. We wouldn't have known that, though, without the raised guidance chart list. So pretty important stuff. But you could go through and look to see which stocks are included on there more than once. Another way to look at it is their scooter should be the same number. So if you do it this way and just look for something, there's GRWG. See the numbers are the same? Scooters, FUBO. FUBO has raised guidance, and guess what? They're on our short squeeze chart list. Pretty cool. Speaking of short squeeze chart list, let's go back here. Let's take a look at short squeeze chart list. I've already downloaded the latest, I believe. Well, it's asking me for my password, so let me just make sure before we look at it that it's the latest. Now, there's some pretty cool features in this chart list I want to show you. So we're going to replace it. Short squeeze, save results. I mean, this chart list alone is worth more than the price of membership. Okay, so when we pull up the short squeeze chart list and we view all in summary form, and if you click on it by name, so it's in order of number, 01, 02, 03, 04, what you'll notice is that there's a percentage in the name. This is the short percentage of float at the last report date. So it's ranked for you in terms of how much short interest is out there. I can tell you these are the 66 highest short percentages, over 20%. with GME at the top at 138. I can't wait till the next update to see whether or not this has gone down. If it has not gone down, my head might explode. I've got to believe that there's been a lot of short covering if this number goes down, but we'll see. But look right behind it. Virgin Galactic, SPCE, 81.5%. Now, aerospace hasn't been the strongest group, but if aerospace starts coming back and more money, I mean, SPCE is already broken out. Before I show you the chart, though, let's look at the periods. I want to show you these short squeeze charts just in the last week. And let's sort it by percentage. GME, 400% this week. AMC, 277. CVM, 75%. AWH, the one that I just showed you that was featured on the short squeeze chart list, 49% this week. And then you could go all the way down. I mean, there are definitely some that lost ground. I think part of it too is look at the scooters. Look at the high scooters. These are the ones that are showing a lot of relative strength. They're going to perform pretty well. How about if we look at the last month? That's since the last short report I sent out. look at GME, 1,576% if you bought GME off of the report last month. Now, holding it for the full month would have really been tough. I would have never done it, I can promise you. I have traded GME, and I have, I didn't hold it. I wish I had. I mean, yeah, hindsight's perfect. I wish I had bought a nice little chunk and just held on to it. I'd be, on an island somewhere hoping that we have internet so I can do my reports. AMC, 479% this month. DDD, Sens. I mean, look, there are 8 stocks here that are up over 100% in the last month. And I think SPWR, I don't know if DDD, but GME definitely was on the list I provided. BBBY. There's SPCE starting to gain some strength over the last month, up 86%. I mean, they have been on fire. So this is a report that will be updated this weekend and sent out for everybody. All right. I know this is taking a long time, but at the same time, I really think this is important for folks. Looked at the January seasonality. Portfolio chart lists. I'm not just going to say you can click on this and use you can download this as a separate chart list right into your account. So you have all of our portfolios. Then we've got special webinars that we do from time to time. We did a kind of a Q4 earnings chart list here where you can download and put into your account. This is companies that will be reporting over the next few weeks that I liked looking at their charts look really good. And I suspect we're going to see some pretty strong reports. You can download that right into your account, all that research. Upcoming earnings chart list. This is something we just added, literally just added this past week. So if you want to know all the companies that are reporting Monday morning, we have a chart list. Any company over $1 billion market cap is on the chart list. If you want to know Monday evenings and Tuesday mornings chart list, you can get that and so forth. So another great feature there. So those are our chart lists. Scanning strategies, I kind of showed a little bit, but we have specific scans. So for instance, one of my favorites is the downtrend reversal scan. So what you can do and this is a great way to use our platform along with stock charts. Take our syntax, copy it. Go to stock charts, go to the scan, just get rid of everything on here and paste. Now, this is going to return everything in the market that has a daily high today greater than yesterday's high, but the last 5 days we've seen lower highs. So picture on a chart a stock that's gone down and printed 5 days in a row of lower highs, lower price highs, and now today it's got a higher price high. So what we're trying to capture is a downtrend reversal. Now, if I just run the scan like this, it brings up everything. So you can check your syntax, make sure it's good, which should be, and then you run your scan. I'm just going to run this one as of the close on Friday and scan results. 355. And look at all these things. The Dow Jones Grease Stock Index. I can't even pronounce some of this. This isn't what we want. So let's go back here again. And now let's add our chart lists. So now we're going to run that scan, but we're going to add, what do we want to add? Strong earnings. We also want to run strong future earnings. And we also want to run raised guidance. Now I'm going to be updating the strong AD chart list, so I won't use that one today, but that would be another one I would consider. Now, if I say to run it again, I want to look for downtrend reversals against these 3 chart lists. Okay, check syntax, everything looks good, run scan. What did I get? Nothing. 0. You're like, what? How's that possible? Well, it does happen. Sometimes you just don't have any, but this scan was not right. Because what we're looking for, remember, there's no common stocks between strong earnings and strong future earnings. So if you use the and clause, you're never going to have a return. You've got to use or. So what it is it's all of this information, and you're going to need a second bracket on the outside because this is going to become a new or clause. And so between the double bracket here and this double bracket here are ors. So now the scan engine is going to say, all right, downtrend reversal, and it can be in any of these 3 chart lists. That's why it's important to use or. Get this question a lot because folks don't realize, that we, folks don't realize that we can run this as an or and be able to separate the chart lists, if you will, as opposed to trying to find common denominators. But anyway, we check syntax. Scan's correct. Now we run the scan against that. And we have 9. So 9 stocks on all of our research. There's 9 of them that have been in downtrends that maybe are trying to reverse. And we can sort it in scooter order. IEA, it's an industrial heavy construction stock, but it's got a huge scooter. I mean, it's one of the best stocks in the market, and it was down 5 days in a row, and now it's reversing. Is that a possible trade? Well, click on it. See if you like it. It's down around the 20-day. It's also testing this prior high. I could absolutely see the stock reversing from here. So, yeah, I mean, it's a possible trade. Maybe you're looking at technology. So you're looking at the semiconductor, or maybe these 2 software stocks. Only problem is this semiconductor's got a 48 scooter. So these don't have scooters. They're just, stock charts hasn't assigned a scooter yet. So let's take a look at PAGs and see what PAGs looks like. Well, it went below. It was definitely 5 days in a row and then starting to show a little strength, but it closed on the low. So I don't know if I'm overly interested in that one. Let's see what Frisia looks like, PHR. This one now is above the 20-day. It's starting to bounce off 20-day test. Solid AD line, relative strength looks good. Yeah, I mean, this is one that definitely would be interesting. I think this is powerful stuff. And you might say, well, which of the 3 lists did PHR come from? Well, there's another cool feature on stock charts you might not be aware of, but if you hit symbol summary and type in, PHR, and you scroll down, it'll tell you which chart lists that PHR is in, which chart list in your account. It came out of the raised guidance. Now, you might say, well, why isn't it in, well, it's not in strong earnings, probably because it's getting ready to report. Actually, no, maybe they didn't beat. I'm guessing that maybe they didn't beat when they came out with their earnings. But the reason that it wouldn't be in the strong future earnings chart list is because, oops, let me go back here. There's no scooter score. So remember, for a strong future earnings, we had to have that scooter at least 80. Doesn't have a scooter score, so it's not going to get picked. That's one thing. Sometimes I'll send stock charts a note and see if they can assign, certain stocks scooter scores. If I happen to see one that I like, that I think is heavily traded, sometimes I'll send them a note so that they can update it in their system. All right, so that's the scanning portfolios, if you want to go back and take a look at our history down here, model portfolio, you can go back and look at every quarter, what we had and where we sold it at. I mean, every single one. And it also gives us our quarterly performance versus the S&P 500. I think that was the only quarter that the model portfolio is underperformed. If we go back, model portfolio beat there, barely beat there, but beat there. There's the loss or the underperformance. Barely beat there, but did beat. Solid beat there. Crushed it there. Crushed it there. And currently crushing it now by about, I don't know, 12 or 14 percentage points. But you can do that for all of our portfolios. You can go back and look history. And we talk about the portfolios in here, how they were created, what we were thinking. And then we've also got these commonalities of all of our portfolios. So you got that. Webinars. I mentioned this earlier, just there's your list. You can always go back and check those out. Exclusive content. Talked about this already, about the things that you can get if you're an annual member. ETFs monthly portfolio report, that's coming soon. ChartLists, I've kind of gone through, but again, ChartList you can download, very similar, same thing, password, make sure you use it. ETF portfolios. This just started. You can see last quarter, one thing that's different is we have this weighted return because in our portfolios, all the stocks are weighted exactly 10%. We put 10 of them in there and they're all 10%. The ETFs, we actually adjusted the weighting a little bit. So you can see how much each one of these ETFs contributed. So PBW, which was only 5% of our portfolio, actually contributed 4 percentage points because it went up 80% in the quarter. So we wanted a little bit of exposure, direct exposure to solar in that quarter, and that helped us outperform the S&P 500. I mean, those are the things that we try to look for. And then ETF webinars, which there aren't very many there. And so that is basically it. I kind of did the stock research and the ETF research all at one time. There really wasn't a whole lot to go through on the ETF research. Maybe after our FAQs, I'll circle back and talk about the strong ETF portfolio a little bit and how our chart list, strong ETF chart list, and how we put that together. So stay tuned for that. But I'm going to take a really quick break just to get a drink of water and welcome Erin Weber in because she's going to help me with this Q&A because she gets a lot more questions than I do. And I think she'll be able to help. Are you there, Erin?
I am. Hello.
Hello and welcome.
Thank you. It's great to be here.
Yeah, it's awesome to have you on here. Hopefully this will be the start of more webinars where eventually you just take over and I go on an island somewhere.
That sounds pretty nice.
Yeah.
For those of you who don't know, I'm Tom's daughter. So if he goes to an island somewhere, I will be visiting.
Yeah, John will be doing the webinar because you'll be on the island too.
I'm already at the island.
He's phoning in from the island. Yeah, I hear you. All right. So I know, we've had a lot of questions and we get a ton of questions into customer support. So the main reason to have this FAQ is to hopefully diffuse some of the questions that maybe many of you all have on your mind right now that we deal with on a regular basis. So maybe it'll save you the time of having to write in and save us the time of having to respond. So I thought, maybe what we could do is go through some of the most frequently asked questions. And I think I'll start by giving some of the basic questions, Erin, that I know you and Abby see a lot of, and maybe you can respond to those and share your screen if you want to point people in the right direction. But probably the question that I see when I do go through customer service a lot, I'm sure you get a ton of, is about passwords. I forgot my password or I'm using my password and it's not working. Those types of questions about passwords. What's the primary reason for those questions and how do they get resolved?
Sure. Let me share my screen. So if you are having password issues, the easiest way to resolve them is to go to our homepage, so earningsbeats.com. And if you go to the member area on your top menu bar, you'll see down below the login area, there's a section, forgot your password. So you can enter in your email address here and click the reset my password, and that will trigger an email to you with a link so that you can reset your password. The other thing, just to quickly note, that's a bit finicky with our website, is your username is not your email address. So you'll see that my username is Erin Weber. We have a lot of people write in who have issues logging in with their email address, so just keep that in mind as well. And if for whatever reason you're unable to reset your password this way, you can send us an email, support@earningsbeats.com, and we'll get back to you and help you out with that.
Awesome. All right. How can members view their account information? If they want to know what their renewal date is or the credit card that's on file, those types of questions, where do they get that information from?
Sure. So if you click login, once you enter in your information, it'll take you into the member portal. And once you're in here, you can view all of your account information. So mine may look a little bit different than yours just because I have some of the administrative rights on my end and permissions, but it should look more or less the same. If you scroll down to the resources section on the left menu bar, there's an option for manage your account. If you click into that, it'll prompt you to enter in your password. And for the sake of this webinar, I'm not going to do that just because, again, my display will look a bit different just because I have different permissions. But once you enter in your password here, you can view all kinds of account information. When your account is set to renew, what credit card you have on file. You can even update your credit card on file if you would prefer to use a different one for the next billing cycle.
Awesome. All right. Well, we need your credit card information, Erin, because we're going to charge you for the next year.
That's exactly why I'm not going to log in. So I don't know what the system has on me. So.
All right. That's good. All right. Next question is, so someone signs up for an annual offer, and we do a lot of annual offers. In fact, we have one I can share with you, webinar offer that we always do. And I'll do that in a bit. But so someone signs up using the annual offer, but their renewal date doesn't reflect that promotion. Why would there be a difference there?
So with how our system is set up on the back end, it will not update automatically if you sign up for a promotion where you're receiving more than 12 months. So a lot of times you'll see with our webinar special that if you sign up within a certain time period, you receive a bonus month. That doesn't happen automatically in the system. And what we have to do on our end is go in and manually adjust your renewal date. So it typically takes us within a business day or two to get that updated. And I know Abby, who also works on the support account with me, she is really great about emailing you to let you know once it's been processed. So you should receive an email just confirming your new renewal date once that gets adjusted in the system. So we just ask kind of in that lull period to just remain patient and trust that we're taking care of it on our end, and we'll get back to you as soon as we can with that.
All right. Question. This one comes up, well, hopefully it doesn't come up very often, but how can I cancel my membership?
So the best way to cancel your membership, you can actually do it through the managing your account. But the best way is to email us support@earningsbeats.com, and we can process it on our end that way.
Okay. That's not encouraging anyone, by the way. So please don't follow those instructions. No, I'm kidding.
Yeah. And there's actually one other thing that I do want to mention about that. So if our team typically works within business hours, I do try to periodically check in over the weekends. I know John does as well, and Tom, I know you work around the clock. But if you do email us and request cancellation over a weekend, we'll do our best to take care of that request as soon as it comes in. It may take place on the next business day. So if for whatever reason you request cancellation and are then charged, we will absolutely treat your request as the timestamp on the email, refund that charge, and take care of your cancellation promptly.
Awesome. All right. Speaking of trials, this is one that certainly bothers me a little bit, because being the CPA, I'm sure it bothers you as well. But we do occasionally have folks who like to try our service multiple times, and they seem to do it sometimes right around the top 10 picks. So if somebody tries to sign up multiple times for trials, what happens?
So if someone tries to sign up multiple times, it will result in immediate cancellation of your trial and a blocked IP address. We take this very seriously, as we know we have a lot of annual members who have been loyal to us, monthly members who have been loyal to us, and trial members who know they have nothing to lose by giving us a try. So we take this really seriously, and we ask that if you find our service beneficial and you enjoy using it, it really does help us out for you to make a commitment to us. So again, multiple trials will result in a blocked IP address permanently. And we've been in business for a long time, as John mentioned, since 2004. So if you had a trial maybe years ago with us, obviously our service has evolved. You can email us support@earningsbeats.com, and we'll consider on a case-by-case basis whether or not we'll open it up for an additional trial.
Yeah, I mean, if there's anybody here who hasn't tried our service in a while, we've changed a lot. I mean, there's a lot more information. I think that this whole entire research and educational platform is, has evolved quite a bit. And so we'll be reasonable about it. But at the same time, it's not just unfair to us for us to be doing all this work for nothing, but it's also not fair to all of our members who are paying us. And so we do take it very seriously. And there are IP addresses that are permanently blocked. And quite honestly, I feel pretty strongly that, that to me, it's no different than walking into a grocery store and picking up, 5 pounds of steaks and walking out. I mean, it's just not fair. It raises the cost for everybody who's in there that's buying the stock, or, the steaks. So anyway, I feel pretty strongly about it. I've got pretty high ethical standards, and I think most of our the overwhelming majority, almost every one of you, follows fine. So it's really not much of an issue. But there are cases from time to time where people are honestly just coming in to get information and they leave. They have no intention whatsoever staying, and that's where it gets a little frustrating on our end. Okay, why am I not receiving emails from you?
So occasionally we have members writing who are not receiving our emails. The first thing that we advise them to do is to double check their spam folder. I would say maybe 5 times out of 10, those messages are being routed to spam. If that's not the case, sometimes it alleviates the issue if you add our email addresses into your address book. So the number one email address where we're sending all of our member communications from that you would want to make sure is in your address book is webmaster. So that's WEBMASTER @earningsbeats.com. That's the email address that we use to send the daily market report out and all of the other reports that you were talking about earlier, Tom. And if you are having issues receiving the Earnings Beats Digest, you would want to make sure that you add digest, DIGEST @earningsbeats.com into your address book as well. And if neither of those options resolve the issue, again, my response is feel free to send us an email and we'll get back to you on that.
All right. Now, I know occasionally, not very often, but occasionally someone will write in and say, hey, I need to talk to somebody there. What's the phone number? Who do I get in touch with? How do I reach you? What do you think there?
Yeah, so we don't currently have the capacity to offer phone support on demand. We are a small team, as John mentioned earlier, and we don't have the manpower to answer phones and also reply to emails and get back to you in kind of every manner there. So for now, we ask, if possible, that you communicate with us through email. If you do need to schedule a phone call for administrative help, we're happy to do that. Just send us an email with your availability and your phone number, and we'll get something on the calendar so that we can connect with you. One caveat there, I know even with us being a small team, Abby and I kind of tag team the inbox, but Tom is just one person on the technical end and John on the technical end as well. And they receive quite a few emails. So if you have technical issues at this time, we are not able to offer phone support. The phone support is purely for administrative help or any questions that you have about our website that Abby or I could assist with.
Hey, let me jump in with one question that came in right now. Someone asked if they can print off a receipt in managing your account.
They should be able to. I know the best way to get a receipt is it should be generated through email once you sign up. There should be a transaction receipt that comes through, but I know that there are ways on our end as well that we can generate a receipt. So if you can't find it within managing your account, you can send us an email and we'll send you a copy of your receipt.
Awesome. So don't call her though.
I've got her cell number. Just a second.
Yeah. Please don't give out my cell phone. I'd have phones up to both ears all the time. Yeah, a couple things I'll just add there. Number one, I've got to say that, really since our service began, John's always been on top of questions, answering questions in the middle of the night, over the weekends and stuff. And Abby and Aaron have just kind of picked right up. I mean, I think we have one of the best customer service teams, and we get a lot of feedback from members saying, wow, I can't believe you got back so fast, or I can't believe you got back on a weekend. And I mean, we man the customer service box, and we try to make it a point that our members don't wait long for questions. And that's another reason why I just don't think it's needed that we have phones. If we weren't getting back to you for a week or 2 weeks or something like that, then yeah, that might become more of an issue. The second thing I want to add is if the customer service team can't answer a question because it is technical oriented and it gets forwarded to me, they normally will let you know that they forwarded it to me and that it could be a little while before I get to it. I can just tell you that for me, it's hit or miss. I am not nearly as quick getting back to folks as Aaron and Abby have been, and John for that matter. If I get a request that comes in and I happen to have a couple minutes and I know the answer right away, I'll try to respond almost immediately. So some of you might get a response back like a couple minutes after you send it in. And then there might be others that are waiting a week and still haven't heard from me. It really depends on my end, how busy I am. Sometimes I just don't even get into the mail. And I do apologize for that, but with the workload that I have and sometimes I do get quite a few questions coming in. I mean, if I spent all the time with the emails, I wouldn't be providing a lot of the services that we provide. So just keep all of that in mind. I do try to make an effort to clean out my email box from time to time, and I'm trying to do better, but there are limitations. So I just wanted to point that out. All right, why don't we go ahead and wrap up the more administrative questions? And there have been a lot of questions that have come in that have been forwarded to me. So do you have some of those, Aaron? I'll go ahead and respond to.
I do. So the first one is, where do I find your specific trade recommendations and performance?
Well, we don't give specific trade recommendations. We're not registered investment advisors. I try to point that out almost every webinar, sometimes during shows and so forth. Earnings Beats is not a registered investment advisor. I'm not a registered investment advisor. No one in our company is registered investment advisor, as far as I know. And so we don't give out recommendations. We don't give advice. And so sometimes, when questions come to me, what would you advise me to do? Hair on the back of my neck curls when I get that, because I don't know anything about your personal situation. I can't possibly answer those questions in fairness to me, because I don't know what your goals, your strategies are. I know nothing about your personal situation. And so someone says, well, where would you buy Apple? Well, I'll look at a chart and I'll say, here's support, here's different things, but I'm not going to say buy it here. That just is not really something that we can do. As far as performance goes, the only thing that we really track are our portfolios, and we do it more from an educational perspective than we do, we don't recommend anybody that they buy our portfolios. We tell everybody what we're doing and why we're doing it, what we like about it, and how we select them and so forth. And then our members are left to decide what they want to do with those, whether they want to invest in the portfolios, whether they want to take those risks, whether they want to just trade some of the individual stocks. I mean, it all comes down to the individual member level. Some like to buy when the portfolios are announced. Others like to wait, see if they get pullbacks, because many of them are overbought. There's so many different ways I could go with this question, but just keep in mind, we're not registered investment advisors, and I'm very uncomfortable trying to tell someone or suggest to someone what they should do with their money when I have no idea of their personal financial situation.
Okay. The next question that we get is, can I just subscribe to a piece of your service? For instance, what if I only want the strong earnings chart list or just the portfolios?
If you paid attention to what we just went through, I mean, our service kind of fits together like a glove. I mean, I think you're doing yourself a disservice by getting just one chart list. So I don't think it's beneficial for our members to have just a piece of our service. And so for that reason, and the nightmare that goes along with it, trying to keep track of different, services for this group versus that group, and, piecemeal a la carte. I don't think we're like McDonald's where you just go in and get yourself a cheeseburger, because you got a water sitting out in the car kind of a thing. I just think you're going to get the most out of our service by combining all of it. I mean, even our portfolios, the strategy that goes into it is very educational. It's not just here are 10 stocks. I think somebody who looks at our service like that honestly isn't getting out of the service what they should be getting.
Okay, thank you. The next couple of questions refer to the portfolios. So the first one is, why don't you use stops on your portfolios?
All right, our portfolios are designed to be, I mentioned this earlier, transparent, simplistic, disciplined. That's what we're trying to, really kind of get across with these portfolios. So I would be, really careful about reading too much into what we're trying to do. I mean, for me, the portfolios is about marrying fundamentals with technicals, and it's also about kind of marrying buy and hold with trading. We swap out the stocks every 90 days, but we only have, but we don't make any changes within the 90-day period. So I think that's the best approach for us, because number one, it is very, very transparent. We know exactly where we got in. We know exactly where we get out. Now, what we suggest to our members is that they decide whatever they want to do, and stick to their strategy. If you want to have stops on it, have stops on it. Here's what would happen if we have stops on it. I can tell you, because when we first started this, we did have stops on it. Members get frustrated. Some members will get frustrated because they don't want to trade. They want these portfolios. They like the portfolios for the 90-day period because they can do their own thing, whether it's working, whether it's retirement, they're out golfing, whether they're going on trips or whatever, and they don't have to worry about these portfolios for 90 days. That's a lot of the appeal. So for some who want to kind of put more of a trading spin on them, you've got just as many on the other side that don't. And so I think that really starts to impact our transparency and the simplicity of these portfolios by using stops. That doesn't mean that members can't use them. I suggest, each member do what's comfortable for them. But that's why personally, in our company, why we're not using the stops on the portfolio stocks.
Okay, so the next question, which is a two-part question related to the portfolios. So firstly, why do you select the portfolio stocks in the middle of the month, always on the 19th? And then related to that, why don't you wait until after the 19th to 25th bearish seasonal period ends before selecting the portfolio stocks?
All right, well, anybody who's been a member of Earnings Beats for a while knows that, yes, the 19th to the 25th historically is a bearish period. And when I say bearish, I mean, it's not like the 19th to 25th sees a market crash or correction every month. Many times 19th to 25th goes higher. There is a tendency for it to go lower. So if that's something that you believe you want to take advantage of and get in on the 25th instead of the 19th, that's fine. I can tell you that based on the history of this portfolio, because we are investing in leaders, in leading industry groups, many of these stocks don't come back. And so if you sit back and you wait for that pullback, some of them, you watch a stock like Tesla and it goes up, then it goes up, then it goes up, and you're waiting for this pullback that never happens. And it ends up being perhaps the best performer in our portfolio. And if we were waiting to get in, it would actually cut into our return. So again, being simplistic, we're trying to just use it very consistently, the 19th of each quarter. And so that'll be February 19th, May 19th, August 19th, and November 19th for our stock portfolios. Now, the reason that it is that time, the 19th, and it's not the 15th or the 28th or whatever, we get through earnings season. So right now, earnings reports are coming out, by the dozens, literally next week by the hundreds. And so it gives us time. By the time February 19th rolls around, we will be through almost the entire cycle of earnings. And it'll give us time to reflect on what's taken place and where our new leaders are. So if we did it earlier, the 15th or the 12th or the 8th of February, I think we're just reducing the number of companies that we haven't looked at yet because earnings either haven't come out or they just came out and we haven't seen enough evidence after the fact. So the 19th just seems to me like to be a pretty good time where we're through most of the big earnings reports, and we can then establish what I think are pretty strong portfolios at that date.
Okay, great. We have one more portfolio question, and then our final question is about the chart lists. So for the portfolios, can you properly diversify a portfolio with only 10 stocks?
Well, I guess it depends on who you talk to. I mean, I believe you can. I don't believe you need 100 stocks in a portfolio. I think the more stocks you put in a portfolio, the more you move toward the S&P 500 return. I mean, I'm trying, to use all the knowledge I have in terms of where I think the market's going. And then I try to use all the information that I can glean from the relative strength, all the knowledge I know about how the market works during a secular bull market in terms of aggressive sectors leading. And I try to put all of that together in putting together 10 stocks that are in different industry groups. I don't put two in the same industry group. I think one quarter we made an exception. I was so bullish on software that I think we had two companies within software on one chart list. It might have been in the model portfolio. I don't remember, or maybe it was the aggressive. And it turned out to be the right call, by the way. But I would just say that, putting 10 stocks in 10 different industry groups and they're all leaders, is it possible that all 10 have a really bad quarter? Sure. And especially if we get into where the market believes a recession could possibly be coming, because then just about all growth stocks are going to get hit. But I'm not going to not pick the best stocks in the market because I'm always fearful about the market maybe going down. If I'm right, 9 times out of 10, I'll take the 110. That 10th quarter that doesn't work. And that's kind of what we've been so far now. I even think 9 out of 10 is crazy. I mean, if I thought we could be right 7 out of 10 times as far as quarterly performance, I'd be ecstatic when we started this. And we're doing better than that. So yeah, I would just say that for me, I think 10 stocks is plenty. I rarely have more than 10 stocks in any of my portfolios, very rarely. First of all, it's just hard to keep track of them if you get too many. So I would say that I'd be fine. But those who aren't, again, we have 4 portfolios, different strategies in each portfolio. That's 40 stocks. And I think historically, I've never gone back and researched what our return would be, but all of our portfolios have done well. So I think you could be in 40 stocks. And one final thought about diversification. I think if you're looking at diversification of give me a technology stock, give me a consumer discretionary stock, give me a financial, give me an energy, give me materials, give me real estate, give me utilities, you're not going to see that with earnings beats. I don't believe, to me, that type of diversification is literally just throwing money away. Diversification is great if you know nothing about the stock market. Doing that would be fine. That's better than not investing. But if you follow the stock market and you understand how it works, putting money to work in utilities and real estate, consumer staples in a runaway secular bull market, you're literally just throwing money away. And the reason why our portfolios have performed as well as they have is because our diversification, quote unquote, is amongst only the areas of the market that have been outperforming.
Okay, great. And then the last question pertaining to ChartLists are, how often do you update them?
Try to update them fairly frequently. I'm going to share my screen. And if you go over to the ChartLists page, you will see these chart lists, and we put the dates in here for the last update so you can see. You know, strong earnings chart list, earnings are constantly coming out. As we get into the heart of earnings season, I like to have it updated at least once every 1 to 2 weeks. I mean, 1 week would be great. So many things going on. It's not easy to do it in a week, but probably within 2 weeks. And then as things start to slow down, it might stretch out a little bit. You might see 3 weeks go by without the strong earnings chart list being updated. The accumulation distribution chart list, we had a week AD chart list, which was back during the pandemic for anybody who wanted to short. I'm not a fan of shorting in a secular bull market, so we've just kind of let that thing go. The week AD chart list, if you look at it now, is going to be stocks that performed poorly back during the height of the pandemic. Some of those have come back. Some of them continue to be weak. But I ignore that chart list at this point. The strong AD is one that we do pay more attention to. We updated it in November. I'd like to have this updated about once every 6 to 8 weeks. And we're on the kind of the far end of that right now, even beyond that. So this will be a priority in the upcoming week to get this one updated. And we're going to need it anyway for the portfolio coming up on February 19th. We want to make sure we have an updated strong AD chart list. So it really varies. Short squeeze chart list gets updated once a month. Strong future earnings chart list gets updated the moment that the strong earnings chart list, they get updated hand in hand. Raised guidance for a while was kind of falling behind. Recently, I've been trying to update that a little bit more frequently. I would say maybe every couple of weeks, very similar to what the earnings chart list, strong earnings chart list is updated. January seasonality chart list is going to be every month. Portfolio chart list, obviously every quarter. Webinar chart lists are just going to be coming out from time to time. These upcoming earnings chart lists will be updated every week. We'll provide you new chart lists. I do want to point out that these chart lists, if you want them and you want to keep them for a while, download them and keep them, because we share so many chart lists. I'm afraid that we're going to be sharing too many, and at some point Stock Charts is going to cut me off. So after a week is over, I've already deleted last week's. So this week you can get, if you want them and you want to keep them in your account, download them and keep them. I would say by the end of the week, by Friday afternoon or evening, if you haven't downloaded them, they may be gone, because I'm going to start deleting those by the end of the week, probably by the end of the day on Friday or maybe early Saturday. So is that it?
That's it. I do have one other thing that I just want to mention as a resource for anyone who wants more information. We hosted a while back an FAQ Friday webinar. You can find the recording on YouTube, and I'll link it in this recording's description, so you'll all have a copy of this. But we did an FAQ Friday webinar where we discussed a lot of the most commonly asked questions. So questions that pertain to our service and our service offerings, but also questions that pertain to Tom and his kind of individual style and how he develops his trading approach. So if that's something you're interested in, all of the questions are organized by category and time-stamped. Do keep in mind this was recorded back in July, so we've definitely changed a few things since then, and we've added a few services. Like this won't have anything pertaining to the ETFs, but it's a good resource if you're looking for just a bit more information. So like I said, I will link that into today's video description on YouTube.
Awesome. Yeah, and while you're there, YouTube, please subscribe. We'd love to have your support there on YouTube. All right, just two things left, and these will both be pretty quick. I'm sorry, things have, it's been a long, I knew it was going to be a long webinar, and everything's being recorded. So everyone will get a copy, and you can go take a look at anything that you miss. If you do have to go somewhere, no problem. I announced that earlier. But the last two things I want to do is I'd like to go through any Q&A to this point about anything we talked about so far, and then I'll finish up with the January effect. So I don't know if anyone's had a chance to monitor questions. Anything specific?
Yes, I answered quite a few questions because we've had a lot. Here's a couple that sort of stand out. Two questions. There's a way to find the stocks that are in different chart lists. Let's say you screen out of 5 lists, you'd like to know which stocks are in all of them. Is there a way to know? And 2, you use a lot accumulation distribution index. Did you ever look at or consider the force index?
I briefly looked at the force index. I loved what the AD line told us back in March, April. I mean, that was a really big find in the midst of that pandemic, because we had so many stocks that just about everything was gapping down at the open, but then it was like a divergence where the high quality stocks that were going to do well during the pandemic were being accumulated during the day. And the other stocks like the airlines and so forth were continuing to sell off even after the open. So, if you didn't spot that early on, I think that made a big difference in your portfolio return and your results for 2020. Fortunately, we did pick up on that very early. I've done a number of webinars. You could probably go back in our history of webinars and go back and find some of them where I talked specifically about the AD line and how important it was and the signals that it was sending to us and that sort of thing. So yes, I've looked at the force index. I haven't looked at it to the same degree that I did the AD line, because honestly, once that AD line started working for us, I'm pretty loyal to something that works. And that had been a huge bonus and benefit to our Earnings Beats members and our entire community in 2020. And so what was that? What was your first question there, John?
Oh, hold on a minute. Like being able to cross check charts,
the different
stocks that might be on all of them.
Yeah. Well, the only way that you're going to have, if you want to run a scan, it has to be an and scan. So it has to be in all of the chart lists. But as I pointed out, if you run the strong earnings and you're also running the strong future earnings, you're never going to get a return because those two don't have any stocks that are the same. So if you wanted to run, say, strong earnings and raised guidance, then yes, you can use the and clause, and that will bring up any stock that's on both of those lists. But you got to be careful which ones you use, and the two biggest ones are going to be that strong earnings, strong future earnings, because they shouldn't ever have the same stocks. The only way they would have the same stocks is if I updated the strong earnings report one day and I didn't update the strong future earnings till 3 or 4 days later. And then during that period, there could have been some overlap. But if I update them at the same time, there should be none. There should be no overlap.
All right, let's end the questions on this one. And anybody has any other questions, they can go to support@earningsbeach.com. We'll try to get back to you. But this one, for the benefit of newbies, can you explain the meaning of the numbers on relative charts? Can see the trend line, just trying to better understand the info provided.
Well, I mean, the numbers on the relative strength, let me pull up a chart so we can visualize this a little bit. So let's go to the strong earnings. And let me make sure I got everybody there. Okay, so everybody should have my screen up again. So here's strong earnings. Let me just pull up Stitch Fix. All right, so when we're looking at relative strength, the numbers themselves over here don't really matter. I mean, in this case, this number is literally Stitch Fix divided by the index. That's what this number represents. I don't really care what the number is. I'm not even looking at the right-hand side when I look at relative strength. I'm looking at the overall trend. Are we going higher or are we going lower? Or are we just not doing anything? Are we just kind of going sideways? That is, you know, and then I'm combining them all at the same time. So I'm looking at actual performance of the index and then relative strength, the stock versus the index, stock versus the S&P, and the index versus the S&P. And as long as those are moving higher, for me, it's not, I don't really care the degree. I just want to know if they're outperforming. And so my simple answer to that question is, I don't care about those numbers on a relative basis. Now that's looking at relative strength in that vein. Now, the other thing that you can be doing is looking at something like a ratio of XLY versus XLP, which let's put this on a different chart. And then let me get rid of the candlesticks because I like line charts here. And then maybe put the S&P 500 down at the bottom. Don't really need the volume. And then let's go out 5 years. Okay, so that now if I'm looking at a ratio chart like this is the XLY, consumer discretionary versus the XLP, consumer staples. If I'm looking at this, the numbers mean a little bit because it's price support. It's relative price support or relative resistance kind of a thing. So if we're breaking out, I mean, I could look at this over the last 5 years and say, yeah, we're going up. But I also kind of wanted to look at key support levels like that dip back in March of 2020. I'm going to stretch this out a little bit. Let's go 10 years. I think you'll be able to see you see all these tops coming in at about 172, 177, 175, 75. Well, when we went down very briefly just below this level and then quickly right back up. That support area was pretty important. I think the only reason we went through is because the market was so panicked. Without a absolute crazy panicked market, I think that prior relative top would have been great relative support on the way back down. And when we pulled back in the trade war, fourth quarter 2018, we easily held that level. And I think we would have held there if it weren't for just the extreme panic. And now we're breaking back out and we've cleared prior highs. This is a little bit different. I mean, I do pay more attention to the relative numbers on a chart like this than I would just on whether a stock is a leading stock within an industry group. I've had folks mention that maybe it would make more sense to use price percentage on those charts as opposed to just, you know, taking the absolute, you know, just because it would tell you more in terms of the extent of the outperformance. For me, I'm just not looking at it in that light, but maybe that would be better for some. Any others?
Nope. Go ahead and wrap it up with the January effect.
Okay, well, we got a couple things I want to do. I did mention I would talk a little bit about the ETFs. And so the ETF service, I just want to point out a couple of things. So let's go over here to this ETF chart list. This is the strong ETF chart list. And we update this once a month. This should also be updated here in the next day or two, hopefully this weekend, but probably Monday or Tuesday at the absolute latest. But I'm going to copy that, click on this link, because it's just like the other chart list we have. All right, I've already downloaded it apparently. But I'll go ahead and save it just to make sure I have the latest. Replace list. Strong ETF. Yeah, I definitely updated it, but let's do it for anybody who came in late. So this is all you do is you just update it, replace the prior. Now it's been updated. And I can then pull up this strong ETF chart list. All right. So from here, if I pull up view all and summary, you will see that there are, actually put it up in edit form. You'll see that there are 79 ETFs. And essentially, when we pick these ETFs, we ignore the leveraged ETFs, so the 2 times, 3 times. I mean, if you wanted to find some of those and leverage your money, that's fine. What we're trying to do is find ETFs that are effectively managed using the various sectors and industry groups and individual stocks and so forth. And I'll show you in a minute how we do that with our ETF analyzer. But all of these have met certain technical requirements for us. We're not trying to be an expert in international stocks. So we're not going to have international ETFs on here. I can tell you, I don't look at a whole lot at agriculture. So you're probably not going to see the agriculture ETFs. What I'm really trying to do is focus mostly on, rather than individual stocks, kind of the next best thing to individual stocks, which is ETFs that own many of these various groups that are outperforming. And so I try to weed out all the others. And so each month we're going to come up with a list for you of what we consider to be some of the strongest ETFs based on the types of stocks that we would trade. So it's not going to be everything. You might, write in and say, my gosh, China broke out and I don't see any China ETFs. Well, we don't cover those. We have a niche at Earnings Beats, and we try to stick to what we're good at. And I'm not going to try to tell you that I know what's going on in China, politically, and everything else that goes along with investing in another country. You got to get into currencies. I mean, there's so many things that come into play. I don't want to deal with that because I don't want to be spread so thin that I can't focus on what I think I'm really good at. So that's why you're going to see this chopped down quite a bit when you go through this list. But these are all ETFs that are performing really well. And each month we're going to update those for you. Then we'll have a bonus 4th update that'll come in right before January 19th, right before April 19th, July 19th, and October 19th, because that's when we have the draft for our model ETF portfolio. It's not the same as our stocks. Stocks are February, May, August, and November. So that's the other reason why you would get a 4th one, is we want to update that list right before we make our selections. So January 19th, maybe on January 15th, you would get an update. But here was the update we had actually for January 19th. All right, now what I want to do is these 79 ETFs, what we then do is we will take them, and I'm going to point you maybe to go back and look at the recording from either the sneak preview. Actually, the sneak preview would probably be best. Sneak preview of the of the model ETF portfolio would have been sometime about a week before January 19th, but you can go in and check that out. But bear with me, because the first thing I want to do is move this, and I'm going to bring up a spreadsheet on this analyzer, ETF analyzer. And so what we've done, and what we do when we update the chart list, we also update this Excel spreadsheet that you can then download from our site. And what it does is it breaks down, for instance, ACES. This is a strong, or it was as of January 19th. It met all of our criteria, and it was one of our strong ETF, strongest ETFs that we included on the chart list. Here, what we do is we tell you the top 10 holdings account for 50% of this portfolio or this ETF. We also go on to break down by sector how much of each sector is in each, how much of that ETF is invested in each sector. All right. Now on the tab, you can go to the holdings and see the top stocks that make up the top 10%. Okay. I think that's really important because, and then the other thing we do is we highlight in bold any stocks that are in our stock portfolios. So you can quickly look, for instance, AARKW, which we decided to pick into our portfolio. We picked it because it's got Tesla, it's got Roku, it's got Square, and it's got Pinterest. 4 of the stocks in our portfolios are in the top 10. So we're obviously going to have some preference on that particular ETF, and that one ended up getting selected for our model ETF portfolio. But all of the ETFs that we show you here are then, we provide you the top 10, and you can look back at the other tab to see what stocks are in there. And then the breakdown. And the beauty here is that you can use these shaded areas to put, you can start to build your own portfolio. It's like building your own pizza. Grab the pepperoni, figure out what you want on it and see, hopefully it'll taste great. Well, hopefully the portfolio will work well based on how you want to do it. So for instance, let's just say, and I'm just going to do this just for the heck of it, but let's say we wanted 20% there, 20% there, 20%, 20%, 20%. Up here gives us our results. So it will calculate putting 20% to all these based on where you're allocating. It will tell you your results right here as to your diversification. So putting those 5 in there, what I first see is that I'm really exposing myself much more to financials. 23% I'm in financials, and the S&P is only 13%. That'll work out well probably if financials outperform the S&P 500. So if that's your call, that's fine. Make sure that that's your call. And then you just kind of go across the list and you see, well, industrials, I'm overweight, but communication services and, communication services, I'm underweight. Consumer discretionary and technology, I'm just kind of, just a little bit above average. Healthcare, I've got almost, I'm 9 percentage points below. Consumer staples, I'm weak. But you can see what you own. And that was the whole thing about starting this service. And one of the major pushes for our ETF service is know what you own. That's incredibly important. I've seen so many investors who, say, oh, these 3 ETFs are hot. I'm just going to put my portfolio in these 3. Well, they may all own, Tesla might be the top holding in all 3 of those portfolios. So you just put a huge amount of money into Tesla, whether you know it or not. Maybe that works out, but maybe it doesn't. And if it doesn't work out, you're going to blame it on the ETF. You're not going to say, well, you know what? I was overexposed to Tesla, or I was underexposed to healthcare, and the healthcare took off. At the end of the quarter, you should be able to look back and see why you either outperformed or underperformed the S&P 500. Either you were in groups that, you shouldn't have been in, or you weren't in groups that you should have been in, or maybe it was the actual stock selection of the ETFs, but you should be able to go back and look and say, okay, we underperformed, and I know why. It was this ETF that had me into, 100% technology, and technology was not good. Anyway, I wanted to point this out because this is a pretty big part of our service too that's recently been put into play. And as you go through and fill in this, you can see right here, you've got an audit, so you can make sure that you add up to 100%. See that no error? If I go back and I just get rid of that 20%, now only 80% needs to equal 100%. So there's an error, meaning you just didn't total 100%. So we have some little things in there. Actually, Matt Townsend helped me create kind of the strong ETF chart list and helps me get a lot of this information. And then Aaron put together a lot of this spreadsheet, which I think is pretty cool, and used some of her CPA skills to make sure that that we've got audits in place so we don't have any errors. We don't want you putting something together that's not right. So anyway, I think that's really cool. And if we go back over to, hold on one second, I'm going to come back to another spreadsheet for the January effect in just a minute. But if we go back over to the website, where did I have that? Well, let's get back to it. All right, so if we go into the ETFs, And it was under the webinars, ETF webinars. That's where you're going to find this EB ETF analyzer. So what I just showed you, that spreadsheet, you can come in and download that. So I think that's a pretty cool feature. I mean, that put a lot of time together, and you can go in and play around with your different ETFs that you might be interested in. And I didn't show you on that spreadsheet, but you can add ETFs at the bottom. You'll just have to go and find, you can find it through Yahoo Finance, but you'll have to put in the allocations to the various sectors in order for it to do its calculation. All right, last thing I have for today, and we're going to go through this pretty quick, January effect. And I find this always to be helpful. It's not my go-to in trying to call the market, but it is another signal, and it does have a pretty good long-term track record. So I think it's worth talking about and mentioning. The January effect, and I'm assuming everybody can see this, but the January effect, let's see, maybe if I can, there we go, zero in on it a little bit. Everybody can see these numbers a little bit better. So the January effect, what it is I calculate the actual return for each year since 1950. This is the S&P 500. I also go back and calculate what the S&P 500 did in January, and then what it did in February to December. Now, if you add up January and February to December, you will come up with 22.16%. And so one question, obvious question would be, why doesn't it agree to 22.63? Here's January, here's the rest of the year. You add them together, they should total. Well, the difference is January's 2.3% is based off of the prior year's, when you calculate the percentage, it's based off December 31st, 1949. When you take this February, December, the balance of the year, you're actually calculating this based on January 31st. So you're not dividing it by the same number, if that makes any sense. So if I use December 31st for both of these, it would add up to the 2263. There's not a huge difference. I just wanted to point that out because that's a question. Anytime I go over the spreadsheet, someone will say you got an error because they're not adding up. That's the reason. So I went through and did this for every year. And you can see that these are all the numbers. Then down at the bottom, what I did is I broke it down into quadrants. And what I mean by quadrants is I broke it down into the top 25% of all the Januaries right here. 1987 was the best January, 13.18%. So if you go back to 1987, there it is. And if you look at all these years, 13% is the best one in January. So it was the top year. So all I did is I took all that data above, sorted it, and then broke this down. So looking back to 1950, we have, I think, 71 years. So the top quadrant is 18 years, the 18 best Januaries, which goes from 13.18% to 4.15%. Then in the second quadrant, the next 18 best Januaries from 4.1% to 1.7%. Then the third quadrant, 1.56% to minus 2.4%. And then finally, the worst quadrant, minus 3% to minus 8.5%. 2009, and that bear market was the worst January. Okay, so what I did from there is calculated averages. So for instance, for these the best Januaries, the average January return was 6.96%. The rest of the year was 15.27%, not including January. This is February to December, okay? So a good January leads to a lot more strength. And so the average full year returns for all of the years that included a strong January is 23%. So if you've ever heard the saying, as January goes, so goes the year, this is what they're referring to. This is, proven fact. Now, what I did is I broke down the number of years higher and the number of years lower that the rest of the year, what happened from February to December based on these 18 years. So 16 of the 18 years, we went higher the rest of the year. 1987 and 2018 were the only two outliers where if we had a strong January, if we were in the top quadrant, we went higher in all but 2 years, 2 of the 18. 16 out of 18 kept going up. 2 out of 18 went down. The years where we saw another 20% tacked on in addition to January, 5 different years. 1, 2, 3, 4, 4, 5. That's where the 5 comes. 5 out of 18 went up another 20%. 13 out of 18 went up another 10%. Now what's, keep in mind that the entire year, the S&P 500 average is going up 9% over the last 71 years. So to have 13 out of 18 go up 10% more after January, on top of the January strong results, I think is pretty impressive. And those years that added another 5% went up 16 out of 18 times. So in addition to having strong numbers through January, you're also tacking more on, significant amount on for 16 of the next 18 years, or 16 of those 18 years. Now I want you to kind of focus on 16 out of 18 and then 5 out of 18 and focus on the balance of the return the rest of the year in that quadrant as we move now to the second quadrant. Because now the second quadrant, instead of averaging over 6% for January's, averages 3% for January's. And instead of averaging another 15% higher for the balance of the year, we average only 10% higher for the balance of the year. And those years, 23% in the top quadrant, 13% in the next quadrant. So they're still good years, but you can see how if January is not as good, the overall year isn't as good. Now, how many years went higher in this second quadrant? 15 out of 18. 3 went lower, 2001, 1994, and 2011. 2 of them were fractionally lower, barely lower. So really only 1 year that was bad. Years greater than 20%, 2 out of 18. Up here, it was 5 out of 18. Years where we went up another 10% or more, 10 out of 18 instead of 13 out of 18. 5% or more, 15 out of 18 instead of 16 out of 18. But still, if you're in the top 2 quadrants, 31 out of 36 years, if you take the 16 and 15 and add them together, 31 out of those 36 years, you ended the year at least 5% higher than you were at January 31st. So being in the top half is a big deal. Now for the unfortunate part. This year is in the bottom half, but it is in the third quadrant. At least it's not in the bottom quadrant, which is good. Third quadrant, the average January return is minus 0.61. We don't have the numbers yet for 2021, but January just finished minus 1.11% on the S&P. So this is where it is placed among the not so good. Now look at what happens. Years higher, the balance of the year, 12 out of 17. 2021, by the way, makes our 18th year. That's why we only have 17 here. And then the final quadrant we'll get into actually only has 17. Next year, we'll make it 18. Anyway, 12 out of 17, we go higher the balance of the year. 6 out of 17, we go lower. Only 2 out of 17 years do we go up more than 20%. 1998, 2003. Of the years going above 10%, only 4 out of 17. Again, remember, 10%, we were 10 out of 18, and we were 13 out of 18. Now we're down to 4 out of 17. Greater than 5%, it's only 50-50. Remember, the top half was 31 out of 36. Pretty strong chance. As you start moving down, worse Januaries, your odds drop. So looking at and then look at the average annual return of years where you fall in this third quadrant of Januaries. Only 1.21% average. And balance of the year average is only 2%. And then the final quadrant, if you happen to fall into that final quadrant where Januaries are really bad, the balance of the year does go up a little bit more than the other, but the actual return for the year is still down. It's -%. So if you have a really bad January, chances are you're going to really struggle the rest of the year. There are exceptions. So what happened in this quadrant? 11 out of 17, we rebounded, saw a rebound, moved higher. The years that were lower were 6 out of 17. How about years where we gained more than 20%? Only one time Think about that for a second. I mean, if you have a really bad January, you would think, okay, profit taking, maybe it was just something, you know, that should increase the odds of going up 20% because we just had a bad January, you know, we'll bounce back. That's not what market tells us. The market tells us if we have a really bad January, it's very strange and very odd to get a return the balance of the year over 20%. 1 out of 17, as opposed to the top quadrant, 5 out of 18, 20%, 13 out of 18 over 10%. You come down here, only 5 out of 17 over 10%. Only 8 out of 17, less than 50-50, returning more than 5%. I mean, you can just see all the minuses, balance of the year. So this is pretty cool. Now, one last thing I did is I pulled all of the years, starting with this one right here. See how it's minus. This is where all the minuses start. So I took all of these years and all of the fourth quadrant and put them into this last thing that I wanted to show you, which is negative January. If you have a negative January, what do we normally look at? And you can see the numbers aren't very good. So this is just one indication. But if we follow strictly what happened in January, it would tell us that 2021 may not be a strong year. Now, I've got one little piece of information that I maybe would try to refute that because I believe we're going to have a strong year. But let me go over these numbers over here first. So years higher, balance of the year, 16 out of 27. Years lower, 6 out of 27. Actually, these numbers can't be right because they don't add to 27. Let's do the negative. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I don't think I updated this. So that was 11. So maybe I need to just put in 11. Yeah, 16 versus 11. Years greater than 20%, only 2 out of 27 years. I think this year could be the third, but let me explain in a minute. So 2 out of 27. So the odds are not very good that we're going to have a big rest of the year. Only 7 out of 27 go up 10% rest of the year, and less than half go up 5%. So strictly taking this at face value, the finish that we saw at the end of January, this last week, the selling would suggest, based on the January effect, that the odds of us having a really strong year have diminished considerably based on how we've performed. Now, the one silver lining that I'll point to, I highlighted in bold the 2 years that we gained more than 20%. Both of them came after the 2003. Remember, the bear market ended in October 2002. So we saw some selling in January, but we had a huge recovery following that. The other was 2009, also coming out of the bear market. So January was rough, but if you recall, we put a bottom in on March 9th or March 10th of 2009. So it was a recovery coming out of panic. Recovery coming out of panic. Well, what did we just do in 2020? We just had the panic with the pandemic. So we're coming out of that. So I think we had a big move up. I think we saw some profit taking. I still believe that we could print the third greater than 20%. I think the market's going up more than 20% from January 31st. And I could be wrong. And I may, at the end of the year, say, darn, I wish I listened more to the January effect. But there are exceptions. It's not a perfect system. But I think you can tell that there's definitely something to it. If January's weak, tendency is for the market to not have the best odds of being strong the balance of the year. So anyway, that's what I wanted to point out on the January effect. That is all I have. I don't know if there was any additional questions on that. That was one of the questions that just came in, asking that very question, because we had a 1% drop. Are we going to have a bad 2021?
Yep.
Well, you can see it's not 100%. It gives us odds, I think, and it does tell us. I think there is a connection. So if you're already bearish, you might say, hey, this is just one more reason for me to be bearish. I'm bullish, so it's one of the reasons maybe for me to consider my bullish stance, but I'm still bullish, and we'll see whether or not that, pans out or not.
Yeah.
But that's it, John. So I'm ready to wrap up. I know it was a long webinar. If anybody stayed in here, we should give a prize out for anybody who's been in here for 3 hours. And
amazing number of people.
15 minutes.
I'll tell you something, that one thing about COVID, people are staying inside.
Yeah, and I did want to bring up one other thing, one last thing I forgot. I didn't do it the whole webinar. And that is anybody who is a current member. We always have these webinar specials, and I never mentioned it. But the big thing is, normally our membership, if you try us for the 30-day trial, and then you just allow it to go into the monthly membership, you're going to end up paying $147 a month. If you like our service, I don't want you to pay $147 a month. We have an annual deal that you're charged $997, which is almost 50% off of that $147. And if you sign up between now and Monday for an annual membership, we'll actually give you a bonus month. So we'll give you 13 months. So instead of 13 months at $147, which would be $1911, you're paying $997, which is a 48% savings. That's a pretty big deal if you like our service. And we do try to, provide you specials from time to time. So I just wanted to point that out, make sure that everyone's aware of it. The other thing is, if you want to try our service, a 30-day trial, and you decide that, hey, this is something I really like, and I want to go ahead and take you up on the annual offer, the 13-month special will be added to the end of your trial period. We're not going to, we're not going to cancel the rest of your trial period. So even if you're just 2 days in, you'll get the rest of your 30 days and then 13 months on top of it. I always want to make sure that we're clear about that. But other than that, I think we're good. I'm ready to go.
Yeah, it sounds like a great idea. And a reminder, I can't believe it. Literally 3 weeks from now will be the top 10 stock picks. And one thing I reminded Aaron about, we talked about, we'll get in the calendar. We always have a public event like 1 week prior where it's a sneak preview of what's going to happen. We'll make sure everybody knows about that as well.
Okay. Yeah, I did see one comment that is too long. I can tell you that it is rare that any of our webinars go this long. I mean, this was, some of what we're doing is we're going to be breaking up the video into little pieces that we're going to have on our website. And we figured, hey, if we're going to do that, if we're going to be talking about it, why not have members come in and some others that may be considering our service and provide us some feedback with questions and things like that. So it's really two-pronged. But most of our webinars, I do try to keep down to an hour. Something big like the quarterly stock picks could go an hour and a half. And anybody who knows me knows I probably spend more time on a subject than less time. So I do tend to run over a little bit. But yes, I agree 3 hours is too long, but we do record all of our webinars. So if you ever need to leave for whatever reason and you just want to come back and check something out, you can always do that. We'll make sure you have the recording. So wishing everybody a great rest of your weekend. We'll be back Monday, get things going again. Do have a lot of reports that you should be seeing coming out tomorrow as well. Everybody have a great rest of your weekend and happy trading come Monday.